Yes.
As in, like Organon has an innovative business, then they have Biosimilar, and they also have established product business. So in all three business areas, I'm looking at how do we grow. I cannot give exact time when we can bring this growth back to the track, but the effort is to do at the earliest possible date.
So like the cost synergies that have been mentioned, Jayashree, is $350 million in 2 to 4 years. There are revenue synergies that are estimated, and then the growth outlook, which you have not put a timeline on.
Right, yeah.
All right. So, Jayashree, when we talk about the cost synergies, you've given the timeline. You said the debt EBITDA levels, and that is 2.3x, which you are comfortable with. Dilip Sanghvi also stated that there is high debt and high risk, and I'm a risk taker. But I want to ask you one question. When it comes to corporate finance, debt equity is a very important factor in getting the required cash flows and generate the growth capital also by debt or equity. It is around 6 times back of the envelope calculation. How are you going to really, give a rationale to such a high level of debt of 6 times of your equity, and also deal with the finance charge at the moment with the huge amount of debt? Because even though EBITDA accretive, EPS accretive, you're saying, but from EBITDA to PAT, a lot will be eroded in terms of finance charges.
Okay, here's a good question. Let me answer it in 2 ways. One, both these companies, Sun and Organon, are cash generating entities. Together, at a pro forma level, they generate about $2.5 billion in terms of cash. And with the growth opportunities that we just spoke about and the cost synergies, the cash generation would only increase over a period in time. With all of this and a very disciplined approach, which Sun is used to, we believe it would be sufficient to look at debt repayment at a decent period in time. Sun has a strong balance sheet, and based on our discussions with the credit rating agencies, we would have a good credit rating. And
what is a decent timeline for debt reduction?
We are not coming up with a timeline at this point in time, but we think it would be lower than what currently Organon has been looking at in their financial projections.
All right, so $2.5 billion combined of free cash flow, but also growth capital is required. All of it cannot be going in for the debt, servicing as well, Jayashree. Sure. So looking at the cash component that you have ascertained to give $2.5 billion out of the total enterprise value that you have already stated. So in that, what is the last cash equivalent with the Sun Pharma? In that also, do you require mezzanine or a financing, so to say? How much cash do you have, and $2.5 billion of full cash do you have?
Yeah, currently we have about $3.1 billion of cash, and 2 to 2.5 would be used out of our current cash surplus for financing the transaction. The balance of about 9.25 to 9.75 is what we are looking at as an external borrowing.
Right.
Here too, our idea is to see if we can swap the existing debt, discussing with the bondholders of Organon, and if that is possible, only the incremental would be a additional financing that we have to pick it up. And we do believe our credit rating would be better than that of Organon today. And therefore, the cost of financing should also be in comparable terms. The reason why I'm saying comparable is some of the debt that has been contracted by Organon was way back when the spin-off had happened from Merck, and those days the interest rates were lower. So we should be able to get a good interest rate, in our opinion. And with the cash surpluses that we have currently and the generation that will come in, that would be good for us to look at the debt repayment.
Right.
You had a question in terms of would you need capital for further acquisition of assets? Obviously, it would be required. But for growth, as Kirti mentioned, there are 2 areas that we look into.
Sure.
Growth by investing in marketing. Growth by leveraging the platforms of Sun and Organon. Growth by in-licensing. So each of these would require some amount of capital, and it has always been factored in both the companies' long-term plan.
Right.
So I don't think that should be a constraint as we go forward.
All right. So that bond, do you have visibility on when the bond maturity could really come in after your acquisition is complete? The first ones, are they maturing a little, in the recent times?
No, we do have visibility in terms of the bond maturity, but I think it will be too premature for me to discuss about the...
Sure. So, Kirti, talking about what you have really gained over here, apart from the global diversification also, which is important right now, and two areas where you sell already existing products and you increase the platform and distribution network that you're selling in. And the second is the growth, also committing to the growth prospect of future, which is biosimilar. But biosimilar entry, while it is a very positive direction for Sun Pharma, but on the other hand, it's a very competitive space. Every pharma company is looking at it for a growth. With this, what will be your USP and moat in really being ahead of the competition with a leverage buyout?
Sure. Now, I think what's important for you to understand is the biosimilar market dynamics. So today, Organon is the 7th largest player in biosimilars worldwide. And they have 6 to 7 products already on the market.
Sure.
So they have a commercial infrastructure,
right,
which is available through which we can sell the biosimilar products. Today, Sun do not have any biosimilar product except few products in India. And what is important for you to also understand is large number of biological products, they are going off patent. As an example, I can tell you is like product close to about $350 billion are going off patent by 2035. So that will also give us a lot of opportunities for you to develop new biosimilars and use this platform to launch them across the world.
Right. So that's 10 years away from now, Kirti. The initial stage of growth and deleveraging will have to be heavy lifted by the combination of the two companies in the existing portfolio that you have, right? So that will be the task ahead for you. But when we really look at, the in-licensing, out-licensing, the line extension you spoke about, biosimilar, and of course, women health, which is the primary thing. And with this acquisition, it puts you number 3 in the world. What are the growth opportunities over there? And out of the 3 segments of 51% with established brands and generics, as well as innovation, and third being the new products, biosimilars, in this, what will be the biggest growth driver in the foreseeable future?
Sure. No, I think you need to put this into 3 buckets. So one part is innovation. So innovation, our current portfolio is 20%, it is growing to 27%. So as I see, this is a part where we need to do in-licensing of the products in women's health area in terms of dermatology so that it can continue to grow.
Yes.
So that growth will be much higher. Today, all our innovative business is growing in double digit. Coming to established product business, which is close to 50-51%, is not growing. So there we have a lot of good ideas in terms of how do we extend the life of the current established brand and how do we launch new forms of those products, new formulations, new combinations, so that they also start growing. But they will not grow as fast as say like an innovative product. And of course the biosimilar is already growing, like it's growing by 13%. And what I talk is by 2035 is the product patent expiries. But there are good number of product patent which will keep expiring every year. So I see the growth opportunity in all 3 buckets. The numbers will differ, but they will keep growing.
In your view, which is going to be the highest growth driver?
Of course, in terms of revenues, the innovative business is always a higher growth driver.
All right. And Jayashree, when we really look at the overall numbers, and you said about the synergistic impact also of 2 to 4 years. In the first year, what part of that synergistic benefit can really be accounted for? Give us a little sense and the rationale behind it.
I think the synergies will start kicking in from year 2 to 4. It would be too ambitious to think that the synergies will come in year 1. In fact, year 1, we could see some amount of cost that could play in because of integration, because of transaction costs. But over a period in time, say about a couple of years, the margins would improve with the synergies kicking in and the growth opportunities also coming in our way.
So will it be also correct to say that for 2 years, there won't be synergistic benefits which will come in while the debt, clock will already start? And yes, you are EPS accretive, but from EBITDA to profits, your financing cost will also weigh in.
Yes, the financing cost will weigh in all through the period until we repay the debt. Having said that, these synergies as they come in will help in improvement of the margins.
And sales synergies, will they start kicking in from the first year? Is that an estimate also?
At this point in time, we only have those ideas. We would be working over the next 6 to 9 months before the closing in terms of further solidifying these ideas in terms of actionables and also looking at the time frame and the values.
Sure. And Kirti, my final question, of course, global diversification is one master stroke with this acquisition. I must say that because our dependence on US has cost us a lot in terms of the tariff uncertainty, which we really looked at for a longest time. And of course, with the new tariff structure, which has been last announced by the US, in that, what is the impact on Sun Pharma at the moment, and how are you going to tackle it, and what is going to be the actual impact on the numbers?
So as I said, it's like tariff impact on Sun will not be very big. We are not quantified and told that the exact number. But we believe that we'll be able to manage the business without having much impacts on our bottom line. Yeah.
So Illumia, that from your specialty product portfolio, from Korea, so that's going to really be attracting the tariff that has been newly announced by the US. And that is a fairly large, sizable business for you from one product. So therefore, I wanted to understand the impact.
No, this is a very complex subject, and we are also working on this to see that it doesn't get much impacted into the business. I won't be able to disclose all the details, but at a certain point of time, we'll also talk about tariffs and tariffs impact on Sun's business.
Well, that was the management of Sun Pharma speaking to NDTV Profit on the acquisition. But let's go across, start taking your stock-related queries right here on Ask Profit. If you haven't already, do start sending them. Let me welcome in our guest, Vishnukant Upadhyay. He's the AVP Research at Master Capital Services, as well as Lancelot Decuna, CIO Value X Wealth Connect as well. Gentlemen, both of you, thanks so much for joining in and patiently waiting by. The first question now coming in on NBCC. Mohit is holding shares at 26.6, so he's sitting on considerable gains. Vishnu, his question largely being, should he continue to hold this counter for the next few months, years, in fact, if the chart trajectory shows momentum? What's your view?
Hi, Puneet. Good afternoon. Yes, definitely. We have seen a very good, strong breakout in today's trading session, and I'm expecting prices to extend the gain towards 100, 102 sort of levels. So yes, he should continue with the position.
Okay, the next one is coming in on Patel Retail. Our viewer Ekambarai is holding 50 shares at the levels of 225. Wants to know if it's it's a good hold for the next 1.5 year, or should he book his losses? Lancelot, any view on this counter?
I think, if you look at the valuation, the stock is trading at an expensive multiple, considering that the margins are fairly low. So one should, probably look at booking loss and exiting from this at this point in time.
Lancelot, the next question coming in on Voltas, and our viewer has bought shares at 1431. This is Saurabh Goyal, and he's asking what he should do for the next 3 to 4 months. Vishnu, what's your view?
Well, so in short term, I'm expecting prices to, reach towards 1570, 1580. And if prices manage to, give a breakout above 1580, then definitely one should, he should further accumulate the position. But for that level, he should hold the position.
Now, in order to answer more queries, I think we've decided to start the rapid fire round and take as many questions as possible because we had a curtailed Ask Profit session. So, Lancelot as well as Vishnukant, you both know the drill. Try to keep your answers as short as possible. The first one is on CESC. After today's breakout, is it a good hold from here on? Is the question. Vishnukant, your view?
Yes, definitely. One can hold the position for the target of 195.
Our viewer Satyan has bought Schaeffler at 4,000 rupees per share. Lancelot, should he continue to hold that by the end of the year?
Yes, hold for the long term.
TVS Motors bought at the levels of 3705. From a short-term perspective, good hold, Vishnukant?
Yes, definitely.
Jaiswal Neko bought by Manthan from Ahmedabad. He's holding shares at almost 40 rupees per share. I know Vishnu, a very limited time frame, but any view on the stock now? Should he book his profits?
1 second.
Sorry, Vishnu, I didn't get the view.
In fact, the stock is trading. You talking about Jaiswal Neko
Yes,
Industries,
yes,
right?
yes.
Yeah, one can hold. The stock is on currently breakout, so one can hold the position.
Okay, HFCL is the other one. 5,000 shares bought at the levels of 70. Can I continue to hold or book profits on this one? Lancelot, any view?
But I think you should book profits.
CG Power, Lancelot, our viewer, wants to buy it for the next 2 years. Is this a good entry point?
If your time horizon is a little longer, then yes, it is a good entry.
Okay, PFC bought at the levels of 415. Soumya from Bangalore is holding 60 shares. Wants to know if she can book profits right now or continue to hold from a short-term perspective. Vishnukant, your view?
Prices are likely to extend the gain towards 490. So for that level, one can hold the position.
Force Motors bought at 21,902, Vishnu. Our viewer V Murli is holding 20 shares at that price. Should he continue to hold for an 8 to 15% move?
See, prices has given a breakdown from the rising trend line support. So he should maintain his stop loss below 19,200.
BEL, can I enter from a current levels perspective from a long-term view? Lancelot, your view?
Yes, if your horizon is long, you can enter.
Sai Kumar is holding on to Shriram Finance at 958. Now, Lancelot's reacting to probably some growth concerns in commentary while the result was still good. What's your view on the stock now?
I think it's better to look for stronger companies one can exit.
Okay, Kajaria Ceramics, 100 shares bought at the levels of 1198. Is it a good hold from a 3 to 6 months perspective, Vishnukant?
Yes, definitely. Hold the position.
Coforge bought at 1493. 10 shares is what M&M Kapoor holds. Vishnu, stocks are 4.5% today, but what's your view on the stock?
In fact, the prices are trading below the key moving averages, so I would, recommend to stay with the counter.
IEX, 272 shares bought at the levels of 165. What should be the next course of action, Lancelot?
I think one should exit.
Colgate Palmolive bought at 2180, Vishnu. Ramesh wants to know what he should do with this counter. Should he still wait for some more time?
Yes, definitely. One can wait because the stock is currently trading in the proximity of 200-day key exponential moving average.
Shakti Pump bought at the levels of 1200 rupees. What should be the future outlook for this one, Lancelot?
Hold, or you can even buy it as well.
Sunny Sharma has bought into BEL at 197. So he was one of the early investors in this rally. Asking what he should do with his 800 shares, Lancelot.
He should continue to hold.
EID Parry, 50 shares bought at the levels of 850. Can I add more? Want to hold from a long-term perspective? Dilip is asking this question. Lancelot?
No, don't add more at this levels.
Narasimha Reddy is unfortunately holding Infosys, Coforge and Persistent all in losses right now. Lancelot, would you be selective or exit all three right now?
So I would be a little selective and hold Infosys and which is the other one you said?
Coforge and Persistent.
Hold Infosys and Persistent. Maybe look at exiting Coforge.
Okay, Clean Science from a long-term perspective. Is this a good entry point? A lot of brokerages have gone ahead and initiated coverage on this one. Lancelot, your view?
Yes, one can look to add.
Transformers and Rectifiers holding at 300 rupees per share by Sunita. Any view here, Lancelot? Should she continue to hold?
It's expensive, so book profits.
Okay, the next one is on Cantabil. 2,500 shares bought at levels of 254. Technical views on this one?
Which is stock? Cantabil.
Cantabil, yes.
Cantabil.
It's a small counter.
Yeah. So the stock is just drifting in a very thin horizontal band. So there is no clarity on the stock currently. So one can maintain the position with a stop loss below 237.
Okay, all right. So that's the technical view coming in on Cantabil Retail. But with that, Lancelot as well as Vishnukant, thank you so much for taking out the time and helping us answer all those queries that we were able to take. But viewers, completely out of time on this edition of Ask Profit. But do stay tuned. India Market Close comes up next.
हर पल मनाओ केसरी त्योहार। विमल, बोलो जुबान केसरी।
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open. Your favorite market show just got better. On NDTV Profit, for your profit. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information plates into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight.
Very good afternoon. You're watching India Market Close, and it's turning out to be a good afternoon indeed on this marvelous Monday. 200 points up on the Nifty. Stayed steady through most of the day. This despite heavyweights not quite participating. So the breadth is good. Even the advanced decline is very, very robust and healthy for a time when Brent is at $107 a barrel.
You know, to add to this, what I would want to say is if you look at the contributors, you'll see the kind of shift that's happened from a Reliance Industries, which has become the top contributor, Sun Pharma, and a HDFC. So you have the top three names which are giving you that run. However, it's the banks which are still, except a HDFC, if you have to look at Axis and ICICI, they are actually forfeiting the kind of gains that's coming in here. But clearly that run-up that has come in on a Reliance Industries, which is at the day's highest levels today. So there is buying that has come in at lower levels on a Reliance Industries, as Parag Bhai was mentioning. And a lot of stock-specific action in the broader markets is what you're seeing.
Absolutely. So on a day when banks are largely sitting it out, IT is largely sitting it out, you're still seeing strength. Look at the broader markets as well, and we'll pull up the intraday of the advanced decline too to give you a sense. The Nifty mid-cap 150, about 1.5% up, showing even more strength, about 2% up on the Nifty small cap 250. The advanced decline through the day, the line graph will show you how the strength is there with the buyers. The bulls are in charge and firmly in charge. The sectoral heat map very quickly will give you a picture of what's working in. It's Pharma that has been dominating through the day. There you have 3% up on the Nifty Pharma and a full green screen.
And in spite of the negatives in terms of Bank Nifty as well, you're seeing there's nothing which is actually drooling under pressure. And this is coming in after 3 consecutive sessions of losses. So I think there is momentum. The question, Tamanna, from here on is going to be, it is a truncated week. For how many days do we see this, and what do volumes tell you? Because by the end of, say, Wednesday or Thursday, you will see volumes that might just come off.
Okay. All right. Even as we're speaking, UltraTech numbers are out, and we'll get you that first cut very quickly. There's a dividend of 240 rupees per share on UltraTech Cement. Better than estimates on the net profit figure, 2,983 versus an estimate of 2,818. Revenues have come in tad lower than estimates as well. So we'll just give you the intraday also. But there you have it, net profit at 2,983 versus estimates of 2,818. This is the other big one that the street was watching out for, isn't it?
Yeah, another big one. So I think the top line is still okay because this will be basis what the pricing is. Because after the numbers is now when they've started taking price hikes as well that we've been talking about. So the commentary from here on for cement companies is going to be important. But categorically, when you're seeing the profit number, which is a tad above estimates, that is one of the positives that you should be watching out for. Apart from that, you're talking of a dividend of almost 240 rupees per share. Let's just look at what the EBITDA and the EBITDA margins are looking at, because a 20% growth in terms of profitability sets the stage as well with regards to how the sector as a whole has performed. If you pull up even a 1-month chart of UltraTech Cement, that will kind of tell you what's the story here. If you could just have an intraday 1-month chart, because a lot has been spoken about cement companies. There you go. Already an up move of 10 to 11% that has come in the last 1 month. So I think the kind of numbers that we were expecting is slightly priced in, and that's what is evident in terms of your today's chart as well, because you're not seeing a major spike that's coming in. There's no major move that's coming in because of that 10% run up. And I think commentary with regards to the first quarter of FY27 will be important now, because monsoon will be taken into consideration. Quantum of price hike and the absorption of price hike is the key.
Okay, so UltraTech Cement there. Let's just recap for you what's happening in markets if we can, and how they fared in trade today. And that's really where the story is, right? About 1% up on the Nifty 50, even as strength continues. Let me go across to Nagaraj Shetty first and get his technical view. He is joining us on the show this afternoon. Nagaraj, how are you looking at the Nifty?
Hi, good afternoon, Tamanna. Yes, Nifty has bounced back very well from the lower levels. That looks like the market remains strong. There was some jitteriness from the higher levels. There was some correction, and market seems to have formed a higher bottom somewhere around 23,800 levels. I think I'm expecting market is gaining strength, and more upside is likely from here onwards, and 24,600 what I'm looking for the Nifty in the next short term.
And what about picks this afternoon, Nagaraj?
Yeah, I have 2 picks from the mid-cap segment. First is one from a railway side. RVNL has been in a moving consolidation phase after a sharp up move. The overall chart pattern is looking bullish flat pattern and likely to break above the 310 levels in the very soon. The overall chart pattern is positive. One can look to buy at this point of time 308.18. Immediate target would be around 325. One can place a stop loss at 300. Second one is Unominda. The stock price has witnessed a gradual bounce back from the lower level after the downward correction moved up again, currently placed at the edge of moving above 200 EMA. On the weekly chart, upside breakout of the downsloping trend line is intact. With overall bullish chart pattern, I'm expecting this to move up. One can buy Unominda currently around 1132 levels. Immediate target would be around 1180. One can place a stop loss at 1105.
Okay. Very quickly, Nagaraj, how are you looking at UltraTech Cement? The numbers have just come in.
Yeah, looking very positive after a decline of last session, bounced back very well of post result. I think the cement sector is looking positive. I think this UltraTech Cement to move forwards from here onwards. 12,400 is going to be the next hurdle to be watched in the short term.
Nagaraj, stay with us. We have Puneet who tracks the space closely to give us the first cut. Puneet, in terms of the numbers, if you have to look at the top 4 numbers along with the EBITDA per ton, what does that actually tell you?
Well, thank you for that. It's definitely a number that's coming in line with estimate on most parameters, revenue, EBITDA margins, as well as profit. All four numbers in line with estimates. We were working with a number of 25,800 crores in terms of revenue, bang in line with that number as well. The margins have actually done better in this quarter at 21.1 versus estimates of 20.4. It's a 70 basis point increase basically compared to the estimates as well, and almost 110 basis points on a YY basis. So despite what we've spoken about, petcoke prices being high, packaging costs being high, the company has been able to manage at least all of those key factors in quarter four. Now, some commentary will be needed in quarter one as to what happens with those key aspects, but the profit number as well, bang in line with the estimates that we are working with. Even also in the operating profit per ton, essentially it's coming at 1,253 rupees per ton. That's 11% ahead of the same time last year number. And this also, in terms of first cut, it's a big number beat that they've done in this particular quarter as well. They've also announced a big dividend of 240 rupees per share for this year, for FY26 specifically. So that's another key aspect. Final thing, what will be something to watch out for has been the fact that on a consolidated profit basis, they've crossed 8,000 crores for the first time in FY26. So all those factors pointing to a strong results, but commentary will be crucial for the company at this point of time in terms of quarter one impact because of raw materials.
Okay, thank you for that, Puneet. So, in some senses, the fact that a good set of numbers was expected is making sure that the response is a little muted to UltraTech because it's in line, neither here nor there. Nagraj, I'm going to do a quick rapid fire with you because there's so many stocks that we need to cover this afternoon, right? It's been a newsy day. Let's start with Cohance Life Sciences, Paytm, Sun Pharma, RIL. And I will repeat it for you if you lose track of all four, but Cohance is the first one.
Cohance is moved up very well. Chart pattern is looking very positive. I think more upside is likely towards 475, 480, which is the next hurdle in the next 1 month.
And what about Sun Pharma?
In pharma space, Sun Pharma is looking very strong today. Bounce back very well from the lower levels. More upside is likely towards 1825, which is the next resistance at least in the next couple of weeks.
Are you liking RIL and Paytm?
Reliance is the one which is chartically looking positive, bottomed out somewhere around 1260, 1270. Bounce back, overall chart pattern is looking positive. More upside is likely in the near term. 1400 is going to be the next hurdle to be watched at least in the next couple of weeks.
Okay, and Paytm was the fourth one, Nagraj.
Paytm is looking weak on the charts. I'm not expecting that to bounce back very well at this point of time.
Okay, all right, stay on with us. We're tracking all the news here this afternoon on NDTV Profit and India Market Close. Varun Beverages has a management call after their Q4 earnings. Let's listen in.
And other approvals. Across Africa, we continue to build scale in snacks and deepen our presence in high potential markets, in line with our strategy of broadening the portfolio and strengthening consumer relevance. In accordance with our dividend policy, the Board of Directors has approved an interim dividend of 25% of face value, rupees 0.50 per share, resulting in a total cash outflow of approximately 1,691 million. Looking ahead, we remain confident in the long-term opportunity across our markets, supported by favorable demographies, rising income, growing urbanization, and increasing beverage consumption. With adequate capacities, a diversified portfolio, and a strong distribution network, we are all well positioned to deliver sustained growth and create long-term value for all our stakeholders. I would like to invite Mr. Gandhi to share the key highlights of our operational and financial performances. Thank you very much.
Thank you, Mr. Chairman. Good afternoon and a warm welcome to everyone joining us today. Let me provide an overview of the financial performance for the first quarter ended 31st March 2026. Revenue from operations net of excise and GST increased by 18.1% year-on-year to the level of 65,741 million in QY CY 2026. Consolidated sales volume grew by 16.3% year-on-year to the level of 363.4 million cases as compared to 312.4 million cases in Q1 CY 2025. This growth was supported by strong volume growth of 14.4% in India and 21.4% in international territory. At the consolidated level, net realization per case improved by 1.6% year-on-year, supported by improved realizations in international territories primarily due to favorable currency movement. In India, realization per case declined by marginal 1.5%, primarily due to volume growth initiatives such as upsizing of packs and selected price point launches in targeting markets to onboard new consumers. CSD constituted 73.6% of total volumes, while non-carbonated beverages and packaged drinking water contributed 7.5% and 18.9% respectively. In line with our focus on healthier offerings, the mix of low sugar and no sugar products increased to the level of 63% approximately of consolidated sales volume during the quarter. Gross margins improved by 62 basis points to 55.2%, supported by early stocking of key raw materials despite an inflationary input environment. EBITDA increased by 21% year-on-year to the level of 15,289.3 million, with EBITDA margins improving by 55 basis points to 23.3%. In India, EBITDA margins improved by 112 basis points, supported by operational efficiencies from strong volume growth and improved gross margins. PAT increased by 20.1% year-on-year to the level of 8,787 million, driven by strong volume growth across both India and international markets. Depreciation increased by 30.9% on account of commissioning of 4 new plants last year in Buxar, Prayagraj, Damtal and Meghalaya. Finance cost increased by 18% primarily on account of the acquisition of Twiza in South Africa, while income on surplus cash in India has been accounted for under other income. During the quarter, we completed the acquisition of Twiza in South Africa, Bevco, at an enterprise value of ZAR 2,053 million. In addition, Bevco entered into a share purchase agreement for the acquisition of Crickley Dairy Proprietary Limited at an enterprise value of approximately ZAR 238 million, including net working capital subject to regulatory approvals. These transactions further strengthen our presence in the region and support our portfolio expansion in adjacent categories. Overall, we continue to maintain a strong financial position supported by disciplined capital allocation, efficient working capital management and a robust balance sheet. With the capacities commissioned over the past year, backward integration initiatives and a strengthened distribution infrastructure, we are well positioned to support growth and drive profitability through improved operating leverage across markets. Despite the inflationary environment arising from the prevailing geopolitical situation, we remain confident in our ability to mitigate near-term challenges through focused execution and supply.
Good set of numbers from Varun Beverages. That was the management speaking. We thought we'll get you a sneak peek of what they're saying. It's an analyst con call that's on right now, about 4% up on the stock. Anyway, with summer factors, you expect demand to go up as well. Nagraj Shetty of HDFC Securities with us, giving us his perspective on the charts. Are you liking Varun Beverages right now, Nagraj?
Yes, certainly looking good. What we have seen on the last 1 month is continuous moving up from 380 to almost 500 to 510 levels. The phenomenal move without showing any reasonable downward correction currently placed at the edge of moving above the previous swing highs, important hurdle somewhere around 510 to 515. Once it breaks above that level, and I'm expecting this to reach towards 560, 565, which is going to be the next set of hurdle in the near term.
Okay, so that's with regards to Varun Beverages, but let's shift focus to Cohance Life Science. That's the stock of the day as well. And I'm sure everyone knows for obvious reasons with the way the stock has been moving, locked in upper circuit. But let's quickly understand what has actually happened. The company has gone ahead and appointed Umang Vohra as the chairman and group CEO. Now, Vohra will actually take charge. There you go. That's Umang Vohra, who's been appointed as chairman and group CEO. He will actually go ahead and take charge from the 1st of May 2026 as executive chairman. That's the first one. And secondly, if you talk about he being the group CEO, that will be effective the 20th of May 2026. Now, the question is, why have the markets actually reacted positively to this? First up, Umang Vohra has been regarded as one of the most experienced leaders in Indian pharmaceutical industry. And if you talk about his experience, that spans over 3 decades in pharmaceutical as a sector. In addition to that, he served as the CEO and MD of Cipla and actually led Cipla's change over the past decade. The 10 years that he spent at Cipla, you know, he's actually made sure that the EBITDA has also doubled. So you know the kind of operational efficiency he got to the table. He's actually made Cipla a diversified global pharma enterprise, and this is from being a Indian-based company, and he strategically repositioned the company from a volume to a value-driven company in 10 years. So that's the transformation that he's brought to the table. Before that, in fact, he also worked with Dr. Reddy's for a span of nearly 14 years. So that's the experience that he gets to the table. Now, why is he a strategic fit for Cohance? First up, he will be able to scale with discipline because he has the proven ability to grow globally amid protecting the margins as well. And that's what we've seen what he's done with Cipla. Secondly, the CDMO mindset is very clear because this will be a shift from volume manufacturing to value partnerships from here on. So it is going to be a customer-centric approach that he could bring to the table. And there is institution building that he will bring, where he supports transition to professional governance-led growth for a Cohance Life Science as well. Very lastly, if you have to see in terms of other factors, the capital market credibility that he gets, because the record, he has enhanced investor confidence and got strategic clarity, and we've seen the way the Cipla stock price has also moved in the past 10 years. Very lastly, if you see in terms of where capital market credibility goes, is the key focus area over here. Stock locked in upper circuit of 20%. So from here on, the impact it could have for the industry as a whole is also very interesting because, Tamanna, if you see a Blue Jet, which also operates in the same field as Cohance, is seeing some bit of a impact there because that stock is also seeing some smart moves.
Yeah, I mean, Blue Jet really, I don't know why Blue Jet is participating in this rally. Just maybe from the point of view that the whole space will get a lift going forward. But our focus on Dynamatic at this point, one of its subsidiaries, Dynamatic Systems, has signed an MOU with Aerodata AG. That's a German aviation player. We're speaking with Dynamatic Tech in just a minute. That stock is up 7% today. But I'm going across to Parth first to set up that conversation. Tell us about this deal, Parth.
Sure. So Dynamatic Systems, which is a deep tech subsidiary of Dynamatic Technologies, they have signed an MOU with the Aerodata AG, which is a German aviation player. Now, as per this MOU, both companies will collaborate to develop airborne surveillance systems for India. Aerodata already has a platform called Aeroforce X, which combines high payload capacity with the maximum endurance, that is up to 40 hours. So this Aeroforce X is actually the heart of this MOU which has been signed between the two companies. Now both the companies will collaborate to design and develop this Aeroforce X for specifically for the Indian market, and This will suit the long duration and the demanding ISR missions that happen in India over both land and sea. So it will be interesting to watch how this MOU pans out for Dynamatic Technologies going forward, how much revenues it brings to the table and how much it impacts their margins and profitability going forward. Back to you.
Okay. Udyant Malhotra, CEO and MD at Dynamatic Technologies, joining us on the show. Ms. Malhotra, thank you so much for your time to us. Tell us first about this collaboration, this MOU you have with aerospace. What does it add to you strategically?
Okay, so firstly, Dynamatic Technologies, as you are aware, has been a pioneer in India's aviation aerospace manufacturing. I'm actually sitting at our UK facility, which co-produces some of the products that we produce in Bangalore. Now, what we've done is in Bangalore, we have a deep tech startup called Dynaton. Over the last 36 months, we've developed not just UAVs, but all the technologies required in terms of the aircraft design, the composite manufacturing, the day cameras, the night cameras, the computer systems, the software. We have over 5 million lines of code. We have all the image processing, including a small supercomputer that sits on top of the cameras that are our design. The optronics is all internal. And then that adds up to a series of birds, of UAVs. At the center of it is the Cheel, which is a 100-kilogram class surveillance platform that flies for 8 hours. We have the Katils that are weaponized loitering munitions, jet-powered, which are controlled and with targeting data from the Cheel. And then we have smaller oversight drones like the Patang and Kawa. Now, with that very detailed end-to-end knowledge, including ground satellite data terminals, we looked at the larger configuration. Our design is parametric, so we can take the Cheel and develop a super Cheel, but that would give us an envelope of a 2-ton class bird, which would fly for about 24 hours at 30,000 feet. We've been talking to one of the world's best mission software companies, which is Aerodata. It's a spin-off from Braunschweig University 40 years ago, set up by 2 professors. And they've actually got something very interesting. They have a twin-engine aircraft which is designed for testing a new generation of aero engines for some of the very large aircraft engine manufacturers using hydrogen. So that's what we are now going to be, we are bringing that and our capability, their capabilities, and we are co-developing. So it's an R&D program which will rapidly have a 4.85-ton class bird.
Okay. Okay, so first of all, very interesting to hear the names of all of these products, Kawa, Cheel, all of these
registered trademarks.
Registered trademarks that you've given. Just want to understand a few details about the MOU. When is this turning into actual orders? What is the potential revenue opportunity? What is the financial conversation between the two sides when you're saying that they're providing R&D?
Right. So it's a collaborative effort. It's not like a typical, most organizations in India tend to bring in a product or products from the ground up. So if you look at this plant where I'm sitting in, it's a UK plant of Dynamatic rigging and stuff. So we have that footprint of ours. We also work with our global rigging and stuff. So we have that footprint of ours. We also work with our global. So we are a single source supplier to Airbus, Boeing, Bell Helicopter, Dassault. So what we are doing here is, instead of being a tier 1, you've gone up to become a pro. So what we are doing here is, instead of being a tier 1, you've gone up to become a platform manufacturer and OEM. As I mentioned, we've developed a whole system of autonomous systems for our global market, with India as our home market. Now, with this new arrangement, this new partnership with Aerodata. We're looking at a 5-ton bird that can fly at 30,000 feet.
You mentioned the 5-ton bird. I just want to understand, are you paying them? Are they paying you? What is the revenue potential of this?
We are both going to pool in our resources.
Okay.
Which is already, both of us have already invested in the core technologies that are required for this.
What is the size? What is the size of that investment? I'm sorry, we're speaking to a cohort right now, who are your investors, so they need the numbers, sir. As exciting as the idea is.
Our investors are fully aware of what we've invested because that investment is in our.
Your retail investors are watching us, sir, who are buying your stock. We're speaking for them. So if you can just give us an idea of the revenue opportunity you see.
Okay, let me give you a straight, simple. There's a global requirement for very large persistent drones. In India, we have a requirement for 87 male class birds. That 87 male class birds will have a buy value of about 25,000 crores. That's the Indian requirement. There are 2 or 3 players in the world that can offer that product. We will be the 3rd player. And ours will be a product where we own the source code, where we own all the data files. We have the design. We have absolute sovereignty over the knowledge. So this system can be weaponized in future with boundary conditions.
So in the next 3 years, what's the revenue that you're targeting out of this partnership, number 1? And number 2, if you're going to be the 3rd wheel, what's the market share that you will get?
There are 2, 3 big players in the world. Some of them won't be, there's 2 players in the United States. There's 1 player in Israel. There's 1 player in China. So the Chinese player probably won't be available to India. If you look at General Atomics, they're already offering their aircraft in India. You have Herons from Israel, which are sub this class, already flying in India. And so there's a requirement for a large persistent bird. We will be offering, and that, as I said, the opportunity is a 25,000 crore business opportunity. But here there's a big difference. The source code, the knowledge, the data, and the design will be Indian owned. That's the big difference.
Fantastic. Just one more aspect. The products that you will develop with this technology partner in this MOU are focused for the Indian defense ecosystem, one assumes. Is there any visibility of demand for that product or for that set of products from the Indian defense ecosystem and from the Indian government?
So the RFI was already out. We're part of the limited RFI that's there. RFQ is expected very soon. It'll be for 87 such platforms, 87 birds, UAVs, and the value, these are very valuable, expensive aircraft. The government budget is 25,000 crores.
That's the potential that we see. Thank you. This is exciting. This is exciting, Dr. Malhotra. Thank you for taking.
This opens up a global market. Yeah.
Okay, a global market. One sec. But then, can you, if this is sensitive data that is available and technology that is available, can you actually service a global market with this?
All the products that I named earlier, the Cheel, the Katil, the Patang, and the Kawa, and this new bird, we have ownership of IP. Okay. So there is no limitation on markets so we can go beyond the Indian market.
Okay, that's exciting to know. Thank you so much, Mr.
Thank you very much
for speaking with us today. For more, Sumit, what's on your platter?
Be quiet.
Multiple stocks that dealers have highlighted. Firstly, it's Kotak. Multiple stocks that dealers have highlighted. Firstly, it's Kotak Mahindra Bank. Now, what dealers are indicating is that there are buy flows on the large HNI desk on this counter. Or for Kotak Mahindra Bank specifically. For NTPC and Walters, there are buy flows on institutional desk
both foreign and domestic institutions have been accumulating both these counters in trade, and delivery volumes are expected to be on the higher side. A small cash stock that dealers have highlighted in trade from long-term perspective, so keep an eye out for FX Industries. And lastly, when it comes to Laurus Labs and Britannia, there are sell flows on the PMS desk. Dealers expect Q4 numbers could be on the weaker side. Laurus is trading higher in trade, but there are sell flows that are coming in on the PMS desk at higher levels.
Segment you should not miss, but we're talking about India's peak power demand, which has surged to an all-time high of 256 gigawatts on Saturday as intense heat waves were felt across the northwest. 56 gigawatts on Saturday as intense heat waves were felt across the northwest. Is the power sector ready to meet the surging demand? Rupesh Sankhe, Senior Vice President Research at Elara Capital. Is the power sector ready to meet the surging demand? Rupesh Sankhe, Senior Vice President Research at Elara Capital, joins us now. Rupesh, very good afternoon to you. Where is the opportunity with the kind of heat waves we are seeing? Because this will likely continue. I don't think power demand is going to crash anytime soon. Can only stay steady here or maybe even go higher.
No, definitely, I think FY27 we are expecting strong power demand led by industrial, residential, agri demand will be significantly higher in this year. So definitely we'll hit all-time peak high for in FY27. In 24 May, we saw close to 250 gigawatt of peak demand, but in the last 2 years, we have seen close to 90 gigawatt of capacity addition has happened. So we have close to 20 gigawatt of incremental supply to cater this kind of a demand. So I guess is that my understanding is that 275, 280 gigawatt kind of a peak demand we can easily manage. We have surplus capacity available. Coal situation is better. So, but definitely the trend is very positive because in the last 2 years we have seen few companies which are 8 to 10% of their capacities are dependent on the merchant market. The regulated players got impacted because of ancillary incentive income was down. Then volumes was slightly lower on the exchange. So, and the coal also e-auction got impacted price. So definitely the key players like Adani Power, who has a 10% of their market in the short term, JSW Energy, NTPC, Tata Power, all stands to get benefit out of this. At the same time, we can see better volumes for PTC India, IEX, because a lot of exchange volume will be there. At the same time, Coal India might get benefit of a better e-auction realization. So definitely next 3-4 years, we can expect this kind of momentum to continue because of the demand drivers which are there in place. And most of these conventional players are adding capacities. Better capital allocation is there because they are generating strong operating cash flows. And in the last 2 years, we have seen their valuation have come down. But in the last 3-4 months, there is a 15-20% gain that we have seen. So, but valuations are reasonable, and we can expect a better re-rating and again some upside still there on the card.
So Rupesh, are you saying good afternoon, Hirale? Are you saying one, valuations are in the favor of investors? Two, in spite of the stocks that have run up in the past couple of trading sessions, there is still value that could emerge if they are buying at current levels. If yes, which would your top 3 picks be?
Yeah, definitely. Say, if you look at the NTPC valuation is now close to 2 times price to book value. But historically, in 2005, 2010, we have seen 3x kind of a price to book value multiple. And the next 10-15 years is a strong high capex, multi-years capex story for power sector. And these companies are greater capital allocation is there toward the green transition phase on the energy, renewable energy side and nuclear side. So we will bet on NTPC in the large cap space. We are also positive on Tata Power because they have got very good presence in entire renewable energy value chain and multiple is reasonable. They have a debt equity ratio of close to 1.1. So they have a scope to leverage their balance sheet for higher growth. And in the mid-cap space, we'll prefer NLC India and CAC. At the same time, we'll have some positive, marginally positive on the Coal India, as well as companies like NHPC and NHJVN is likely to better. At the same time, PFC REC will continue to get the funding opportunities which are there for next 10 to 15 years. And NPA issues are going down, Discom financials are improving, and those companies are trading at a very, very reasonable valuation.
Okay, thank you so much, Rupesh, for speaking with us, and definitely that's one space to watch. Siddharth Khemka joining us this afternoon. He's Head of Research Wealth Management at Motilal Oswal Financial Services. Siddharth, very good afternoon to you. And the summers are scorching. The markets are not quite scorching, but I would say definitely better than expected. And
Good afternoon, to Tamanna. I think, yes, in this global turmoil, a lot of focus is there in the quarterly result season. And we have seen that numbers are driving stock-specific action. And more importantly, if you look at the commentaries, wherever there has been a positive or supportive commentary, stocks have seen kind of the follow-up buying that we are seeing in some of these stocks. So I think clearly, if you look at the market in the last couple of days, clearly the broader market is participating much sharply compared to the benchmark indices, and that is largely to do with what the broader market results are doing compared to the larger ones, which are more globally tuned and more sentiment driven, given the higher stakes of FIs, which have been on the negative side for last couple of months.
You know, I'm wondering how you're looking at the bounce that we've seen in IT, Siddharth. Is there any reason, apart from, I would say, sectoral allocation or the fact that it's been beaten down so much, for the Nifty IT to show a 2.5% uptick today?
I think, Tamanna, it's purely, I think, some sharp, we can say a bounce after the sharp fall we had seen last week, post the disappointment that came in from HCL Tech and Infosys. Tech Mahindra was largely in line, but that did not stop the IT companies falling sharply, and especially the IT index that had witnessed a significant sell-off. I think it's a marginal pause, but clearly the view, at least in the near term, that remains a bit negative, given that there is still a lot of macro-related headwinds for the entire sector. The AI-led disruption that is definitely impacting the sector, as well as the margins that are not witnessing any improvement. The only, I would say, the saving grace is your valuations have become comfortable, and the order book that is the order book pipeline as that is pretty strong. The only thing that now this order needs to convert into revenues, which I think is taking some time, especially in some of these sectors which are the US Europe focus. For example, telecom as a space is witnessing a significant drag, and that is impacting a lot of these companies. BFSI is also not recovering to the extent that would have helped the Indian IT services.
Okay, so that stay with us. We're taking a very short break, but we're adding to the conversation. Gurmeet Chadda of Complete Circle on the other side with us. So will we be speaking to Rudramurthy BV of Vachna Investment. So we're going to get a lot of views on the other side of the break in what is turning out to be quite an interesting closing session. Don't go away.
केसरिया से मन जो
में देखो मैं तुम्हारा हूँ बड़े केसरिया से मन जोगी हूँ।
हर पल मनाओ केसरी त्योहार। विमल, बोलो जुबान केसरी।
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance.
All right, welcome back. It's a marvelous Monday, I would say, because look at the kind of boost that you're seeing in markets right now. The Nifty comfortably above the 24,000 mark, not yet staying at 24,100. But Rudramurthy BV joining us in this leg of the conversation. Siddharth Khemka with us, as is Gurmeet Chadda. Rudra, I'm going to get a quick technical view from you first on the Nifty and the Bank Nifty.
See, good afternoon, Tamanna. For me, market is trading in an inside day. If you see the range what we had on Friday for Nifty, today both the high and low are within the Friday's range. So for me, market is now consolidating between the 23,800 on the downside, and on the upside it is 24,200. So it's a 400 point kind of a range in Nifty. And markets are very, very stock specific and sector specific. So similarly, if you see Bank Nifty, yes, there is strong support at around 55,700 zone, and you have resistance at around 57,500. But if you see the broader market, if you see the mid and small cap participation, advanced decline ratio, they're all very, very positive. So for me, you have to be very sector specific and stock specific till Nifty breaks out of this range of 23,800 to 24,200. It is most likely to break on the upside. So if you want momentum, wait for close above 24,200 before going long on Nifty.
What are your picks this afternoon?
See, for me, there is a lot of strength when it comes to energy and power. I'm picking two stocks again from the same sector. For me, JSW Energy looks very, very strong. Stock is headed towards 600 zone. One can definitely go long having a stop loss of around 560. And another stock which is very strong from the same theme is Tata Power. So again, Tata Power holds a strong support at around zones of around 430. So I will be a buyer in Tata Power looking at target of 480, 500 and having a stop loss of 430. So a buy on JSW Energy and Tata Power.
So JSW Energy, Tata Power, two picks coming in from Rudramurthy as well. Gurmeet, let me come to you. Good afternoon, Hiral on this side. You know, we've been talking about themes which are actually emerging as buying opportunities. Your markets are up after what? 3 consecutive sessions of decline. A lot of participation coming in, and power as a sector has been seeing green shoots. How sustainable is that, number one? And two, do you see any picks at current valuations as well?
Thank you for having me. I think power equipment is one space we've been pretty focused on, and I've got a little lucky in this current upside. So we have CG Power in the portfolio, which is almost at for railways, and now obviously is finding applications in other segment. Also, they're getting into power for railways, and now obviously is finding applications in other segment. Also, they're getting into power electronics, robotics, data centers after the acquisition they did in France, Hind Rectifier. Then we've also added in March, February lows, Vari Energy. I think it's a very, very integrated play in renewable. But the focus continues to remain transmission and distribution, which is where even if you see the National Electricity Plan, envisages almost 9-10 lakh crores of capex. So whether those are transmission lines, HVDC, transformers, substations, conductors, I think there is value across the curve, but you have to be a little careful of the valuations. Most of the stocks like GE Vernova or Hitachi or Siemens, they are already at almost all-time high or trading at very high multiples. So maybe a buy on dip, but looks like a very structural opportunity. Also, the energy mix and the landscape is going to see a huge change. One area which we are also monitoring is if government really comes up with E85, which Mr. Gadkari has been talking about, and can give a bit of a fillip even to the the ethanol, the sugar and distillery space. So we're pretty overweight on energy. I think overall, I think we would be like 20% in the portfolio.
Okay, so that's with regards to power companies. But another stock which is actually powering in trade is a Sun Pharma. The anticipation was whether this deal will be taken positively by investors or not. With the 10% correction that we've already seen in the last 1 month, and there you go, a 7% up move coming in on the back of the acquisition that they've made. And this is a New York listed women's healthcare company, Organon, and this is what is likely to be one of the biggest Indian outbound deals in years. Varsha is here to tell us what is actually cheering the street. Varsha, you've heard the conference call, you've heard what the management had to say and met the management at the press conference. What are your key takeaways when it comes to the debt level of the company, how comfortable they are with the kind of debt they will be raising and the outlook that they have?
This is the largest deal that the Sun Pharma is doing after Ranbaxy. But why Street is happier today? Because earlier, a few days back, Street actually investors punished Sun Pharma stock on the same deal. But today, they are rewarding the stock. Why? Because if you see, Sun Pharma is buying out a company which has a high debt and has a slow growth, and Sun Pharma itself will have to take significant debt to, for this deal. But management in the press conference clarified, or they gave comfort on the cash flow generation. Because if you see, combined entity generates $2 to $2.5 billion of free cash flow, giving confidence on fast deleveraging. They also said that they are expecting to, wipe out this debt over the next few years, though they have not given the timeline. Also, if you see, Street is valuing the jump to top 25 global pharma plus $12.4 billion of revenue scale. And this is a portfolio upgrade, not just an acquisition, according to the management. Entry into biosimilars plus leadership in women's health are seen as a structural growth driver. Even biosimilar, which currently Sun Pharma is not into, is expected at 6% post this deal. And the Organon, which is growing at a 1 or 2% in a year, is expected to grow into high single digit over the next few years. Also, management also talked about the synergy visibility, $350 million synergies plus cross-selling opportunities do provide earnings upgrade cushion and execution credibility premium. If you see, the Sun's track record plus Ranbaxy learning gives comfort when it comes to integration risk. And lastly, 100 plus assets pipeline in women's health is seen as a hidden long-term upside for this company. So overall, if you see, because of all these reasons, we are seeing the stock is up almost 7% and the street is rewarding Sun Pharma on this Organon deal.
So what is the timeline that you have set internally for the turnaround from 1 or 2% growth of Organon to higher single digit? In how much time and visibility, if you can give at least by internal matrices?
So what we said, I think you have to look this business in two lenses, is we will generate certain cost synergies.
Yes.
And this cost synergies close to about $350 million will get generated over a period of 2 to 4 years. And in my opinion, there are good or large number of sales synergies, which right now we are evaluating, and it will help business to grow further.
What is the last cash equivalent with the Sun Pharma? In that also, do you require mezzanine or a financing, so to say? How much cash do you have, and $2.5 billion of full cash do you have?
Yeah, currently we have about $3.1 billion of cash, and 2 to 2.5 would be used out of our current cash surplus for financing the transaction. The balance of about 9.25 to 9.75 is what we are looking at as an external borrowing. Here too, our idea is to see if we can swap the existing debt, discussing with the bondholders, of Organon, and if that is possible, only the incremental would be a additional financing that we have to pick it up.
Siddharth, what did you make of the Sun Pharma deal and the kind of response that we've seen today?
Yeah, Daman, I think the biggest challenge was that the street was fearing to fund this kind of large acquisition. The company could go in for a dilution, and that would have been a negative impact clearly with the dilution kicking in. But I think that has been clearly denied by the management in the con call, and that is what I think was one of the bigger positive triggers for the stock to move up today. In terms of deal contours that you already know, but what makes a strategic decision is that it doubles the revenue nearly for Sun Pharma. EBITDA scales up much largely, and there is a strong free cash flow. So from the day one, the acquisition is EPS accretive, and hence I think there is further potential of synergy because there is not much of overlap. So there is negligible overlap between Sun and Oregon business, and hence we believe that the overall strategy could deliver value over the next 2-3 years.
Gurmeet, just because there's been so much focus on Sun Pharma view as well as the pharma space right now.
So I think the concern with Sun Pharma has always been capital allocation post the various acquisitions done. And I think the clarification on how they want to reduce the debt, how they're going to finance this actually is given a bit of a breather. But we should say, I think this women healthcare portfolio has been in focus. If you see in domestic markets, Mankind Pharma acquired Bharat Serum and Vaccine for almost 14,000 crores, one of the largest domestic acquisition. And the synergy has taken a bit of a time, and the stock obviously went through time and price correction. This is one area where everybody seems to be focused on in terms of growth. Also, as my colleague said on the panel, that on biosimilars, it gives them a thorough play. They have been already focusing on specialty portfolio, over a period of time, and that has helped them. So we need to see how it goes because, synergies and a lot of things take time. We've seen that with domestic case of Mankind, but clearly a future good vertical. We continue to like the CDMO space. I think we are also hopeful somewhere down the line you will see the Biosecure Act coming in US, which puts restriction on Chinese companies, especially with respect to genome.
But Gurmeet, would you put in, would you see this as a good time to enter for the pharmaceutical space and all of these positives fundamentally priced in? Or are you seeing more opportunity and further upside there?
See, you got to be selective. So, for example, in hospitals, there could be a cap on pricing. There's already pressure on the government on private hospitals. The valuations are very expensive, whether it is Max or Apollo. Even Narayana ran up from the lows. So, Narayana may not get impacted from a price point of view. Generics, I'm not sure. Because it's essentially is a low margin business. But branded generics like the homegrown players and CDMO names are very good. There's a lot of R&D happening. There's a lot of capacity building happening in crop science, in peptides, across. And there's been a lot of focus capex. Just see the capex Laurus Divis has done in last 3-4 years, probably will be equivalent to what they would have done in last 2 decades. So that's one space. And there is very good relationship with the innovator pharma company. And once you get into the supply chain, there's a very high entry barrier, especially in the late stage cycles. So we are more bullish. So we have Laurus, we have Divis, we have Newland in the portfolio. Branded, we have Mankind Pharma. But we are, as I said, we are avoiding the hospital space as well as only generic space in Pharma.
Yeah, very good insight as well on the focus on women's health, and I would say about time that actually happens. Murthy, you want to quickly give us some BTST ideas? Just 10 minutes to go.
Yeah, so for me, market is definitely closing on the highs of the day. So it is a bullish setup for me. So I will be buying REC Limited, currently trading at 378, looking at targets of around 390, and one can have a stop loss of 375 for this.
Okay, REC is one that you should be watching out for. A couple of financial names which are in focus are Tamil Nadu Mercantile Bank. strong set of numbers that have been reported. If you see the stock as well, seeing some strong moves in today's session because your asset quality has improved, your operating profits are up on this one. And if you have to look at the NI, up almost 24%. Simultaneously, if you have to look at a M&M Financial as well, that stock has been surging in trade. A lot of brokerages which have been positive, stock up nearly 7 to 8%. You have IDFC First, which already reported numbers. Hindustan Bank was another one which was in focus as well, and a L&T Finance. If you have to look at this entire category, specifically if banks and NBFCs, Siddharth, how are you looking at them? Anything that you like, which could still be good buys at levels that they are at today?
Definitely, Irel, I think the entire banking space looks interesting, banking and financials. So for this quarter, I think the financials are expected to report much stronger growth, followed by private banks. Public banks on a high base, I think the growth numbers are a little bit impacted, and also because of the impact on the treasury gains, mark-to-market losses that they would be booking because of the higher bond yields. But nonetheless, I think there is a fair interest that we see in some of the large private sector banks, the likes of ICICI Bank, which continues to deliver quarter after quarter. SBI is the other one where the quarterly results are much better, and we are expecting the strong performance to continue. I think these are the two preferred large banks that we like. Within the mid-sized banks, I think Federal Bank is something that is really interesting in terms of growth as well as valuation that they have delivered. And I think within NBFCs, that is the space that looks interesting now because a lot of changes are happening on the rural front with the monsoon expected to be a bit delayed and bit lower because of the El Nino impact. The second is because of the expected rise in the fuel cost impacting the vehicle financing companies. That is also impacting. So what we believe is that companies focused on the retail lending and consumer credit, that is something which is looking interesting in this environment.
So I actually want to follow up with you on Shriram Finance in a little bit of more detail, Siddharth, but let me just get in Shivam, my colleague, talking about M&M Financials. It's seen the single biggest gain in a day since November 3rd, 2022 after its results. What's worked for them? Shivam is here with more.
Well, yes, M&M Financial has been up over 9% in today's trade. So let's quickly take a look at the factors that have worked for this stock. So first one is the strong quarter for earnings, and the AUM momentum has also been building, and with the asset quality at a multi-year high. Profitability and margins have also witnessed an improvement in this quarter. The strong fee income has also been one another factor where it has been partly offset by the higher credit cost, and slippages have also reduced. Net interest margins is expected to peak up at 7.5% in quarter 4, and gross stage 3 assets have also seen a record low of around 3.4%. Now coming to the brokerage's view, Citi has maintained a buy rating and has cut the target price to 380 from 425, and has stated that the prolonged geopolitical tensions may weigh on the underlying vehicle sales. Mercury on M&M Finance has also maintained underperform rating with target price of 280 and has stated that the net interest margin growth is temporary, and the credit cost has been on the elevated side due to the overlay for FY27. Kotak Securities has also upgraded to buy from reduce and has hiked the target price to 350 from 340 rupees, and the brokerage says that the company is better placed for a challenging year ahead.
Thank you for that, Shivam. Gurmeet, the way Shriram Finance responded, and some brokerage notes out there also explaining what the concerns are, but how have you looked at the numbers? Because the numbers were frankly in line.
It ran up to the one, and just see the movement in Shriram post the deal. I think some of it is in the price. I think, but there's a lot of interest in housing finance. I've been personally speaking to a few unlisted players. Some of them happen to be our clients. There's a lot of interest in housing finance. And you will probably see more deals both in listed and unlisted space. There are a couple of tier 2 banks, including public and private, where there's a lot of FDI interest post these deals which have happened. So, and that's the reason. I mean, who would have thought you will have so small banks and NBFC doing so better than the leading private sector banks? Just see the outperformance PSUs and some of the tier 2 banks have had. So somewhere I think the asset quality, once it stabilizes and if growth numbers are identical, and your operating metrics are identical, that's where the re-rating happens. So pretty constructive, more on housing finance now. And we are also adding some gold-based NBFCs. I think there are more legs to it. And this is one area where the credit cost and the SMA1,
Who are your top favorites in the gold-based NBFC space?
So we have Muthoot in the portfolio, and we are looking at some banks which are growing the gold loan portfolio, including Federal.
Siddharth, quick view on Axis. Was really punished today, and there was a massive miss of any kind in Axis. Can't even say that's the same story as Shriram Finance, where everything that we saw was in the price. Asset quality is improving. Why do you think Axis saw this kind of a reaction, and do you find it attractive at the current valuations?
Definitely, I think result-wise, more or less in line with expectation. I think the core performance that remains healthy, but there is definitely some slippages in terms of asset quality. That so the asset quality improves by the tax reversals utilized. That is used to strengthen the provisioning. But I think overall, things are improving for Axis and looks interesting compared to some of the other peers which are still struggling. So I think more or less this is a reaction that the results are out. There is no much trigger and some profit booking taking place. But in terms of valuation, looks attractive compared to some of the peers, given that next year we are expecting earnings to grow at almost 28-30%, and the stock is trading at about 1.7 times price to book next year. So there is decent upside. I would say about 10-15% upside that would be there in Axis Bank from current levels.
Decent upside there. Coal India will be reporting numbers today. Parth is here to tell us what the street is expecting. Parth, over to you.
Thanks, Cyril. So Coal India is expected to report a muted quarter, this time due to weaker volumes, but slightly supported by the better realizations. They have seen some premium improvement in their e-auction prices, which will support their overall blended realization. But the volume decline will remain a key drag for the revenues in this quarter. Margins are expected to improve sequentially on the basis of improvement in blended realizations, but the demand trends have remained weak for the quarter, and due to the weak offtake as well that has been seen in the couple of months. If we talk about the Q4 expected numbers, then revenue is expected to rise 1%, while the EBITDA also is expected to fall 1%. Margins may decline by around 130 basis points to 29.8%, while net profit is expected to fall around 12% to 8,470 crores. About the factors that will impact the earnings, we already discussed that the coal offtake has already declined 1 to 2% year on year, which will impact the overall volumes, and production has also remained largely flat during the quarter.
Right.
And,
all right. Parth, we'll have to close up the markets. Thank you so much for that. You have 1 minute, 40 seconds to go. Gurmeet, Siddharth, Rudramurthy, thank you so much for joining in today on the show as we wrap up what's happening with markets today. Close to the day's high, but off. Just about 24,100 there in the pocket. The Nifty heat map is what we should pull up very quickly. Axis was hurting. Sun Pharma is up and about 7% up on Sun Pharma. And we were having this conversation this morning, Hiral, that it's a big leap of faith that Dilip Sanghavi is taking. He's explained how he's going to fund it. He's saying he's going to pay back the debt, and the market has rewarded it. It's a complete endorsement there for the leader as much as it is for the idea and the acquisition.
And what he categorically said was that it's going to be the growth that Sun Pharma has and the operational capability that they will bring to the table, and that's what will be the turnaround story. But what's interesting is Shriram Finance pulling you lower, Axis Bank. You have Eternal, which will be reporting numbers tomorrow. That stock is down nearly 0.7%, just ahead of numbers.
But also because of, look at what Amazon has announced today. They've announced their expansion plans in 100
for Amazon now,
areas for Amazon now. So you have now a mega giant getting into quick commerce. So Eternal is definitely big, but then you have an Amazon coming in, then maybe a bit of a pain point over there as well. India VIX, I just want to pull up India VIX, 7% down. The fear gauge is very benign right now. That's reflecting the market mood. That's important. Advanced decline ratio is also quite fabulous. 1:5 or 1:4 really for advances to decline. That means this is a bullish momentum going on. We'll just wrap up quickly with the sectoral heat map as we close off this Monday morning, and just reiterate that more and more while the West Asia crisis simmers, markets seem to have now looked at value, which has come into the fore. All green screen. Private banks is the lowest gaining sector. Consumer durables, Nifty, Pharma, Reality, all of them doing very well.
And you have your broader markets as well, which have really done well. Your small cap index was up nearly 2%, and I think those are the kind of gains that we are closing in for trade as well today.
Yeah, it's been an action-packed day. That's all the time from here and me and the team that put together this show. But stay tuned. In case you've missed all of the action of the day, Market Express is where you should tune in to get your fix. Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company, weekdays at 11:30 a.m. to understand your next big bet. New year. New power panel. India market open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar.
Good evening. You're watching Market Express with me, Shreyanti Singh, and this is the show that gets you a snapshot of everything that has happened in the trading session today, be it stocks and the movements when it comes to those, or news and updates from within the country as well as across the globe. Let's get cracking on the show then. Talk about the markets. First things first, winning day on the last street is what you saw. Nifty managed to end above that 24,000 mark, thereabout, just above that mark. And the Sensex also ended above 630 points. So that's nearly the uptick that you're seeing, about 640 points thereabout. And broader markets also outperformed the benchmarks. Let's also talk about the sectoral picture then. It was a sea of green across the market today. Pharma and IT stocks led from the front, while metals added shine, and oil and gas stocks also chipped in with steady gains, signaling that broad-based momentum and a clear risk-on mood. Let's also talk about oil prices that are surging yet again as the Strait of Hormuz remains effectively shut, keeping global energy markets on edge. So Brent crude, that was hovering close to $108 a barrel thereabout as peace efforts stall and supply risks remain elevated, while a ceasefire technically holds trade through the crucial waterway, in fact, remains blocked, choking crude flows and also fueling fresh inflation concerns worldwide. And that's something that you're looking at that was really moving energy prices as well, and volatility is firmly back at the center of the global narrative. Let's also talk about some of the counters that were buzzing away in trade, and from within the Nifty 50 pack, you're looking at Shriram Finance with that nearly 3.5% knock also coming in. But that's after a largely strong quarter led by solid operating performance, tight cost control as well. Margins remain stable as lower expenses support profitability, and growth, in fact, is staying healthy. The street is clearly watching for some acceleration coming in as the next trigger, and the lower funding costs, also something that you're looking at, continues to provide support even as brokerages flag growth execution and macro risks. Let's also talk about something like a Cohance Life Science that was locked in the upper circuit. About 20% uptick is what you saw coming in after Pharma veteran Umang Vohra was going to be joining as chairman and group CEO. And since that announcement was made, you saw a very sharp spike in the stock price. Now, the market was cheering this particular move, citing his long experience and strong track record in building global value-led pharma businesses. Investors, in fact, see this as a key step in strengthening leadership, governance, and long-term growth visibility for the company. Let's also talk about something like a Tanla Platforms that posted a steady set of numbers in the fourth quarter. That stock was also buzzing away in trade. Revenue, of course, was supported by enterprise communication and its platform business as well. When you talk about the operating profit growth, that lagged just a tad bit because of employee and operating costs that remained elevated, leading to some bit of pressure on the margins. Now, that said, cash generation stayed strong, and AI-led platforms like Wisely and MAP also continued to gain traction, helping the company really scale its platform-driven growth model. Let's also talk about something like an IndusInd that was in focus on the back of delivering a sharp turnaround in the fourth quarter, driven by strong operating performance and lower credit costs. Now, when you talk about the stock, that was up about 6% in trade at the very end of trade as well. And net interest income, that's the one that's jumped about 43%. Operating profit swung sharply into the black as well. Provisions fell significantly, helping the bank post a net profit of close to 500 crores compared to a loss a year ago. When you talk about the margins as well, you're looking at stabilization here as well. Asset quality improved with both gross and net NPAs edging lower, signaling that better balance sheet traction. Let's also talk about the brokerage verdict coming in on IndusInd Bank as well that remained mixed after the Q4 performance. HSBC has reiterated a buy call, raised its target price to 1100 rupees from 880 thereabouts, citing sharper earnings recovery, and has lifted its FY27 and FY28 EPS estimates by up to 20%. When you talk about the word coming in from Morgan Stanley, in fact, they've stayed equal weight with a target of 730, calling the quarter encouraging, but flagging that profitability improvement is likely to be gradual rather than sharp. Moving on then, let's also talk about something like M&M Financial Services that's in focus on the back of jumping over 9% thereabout, ended the day with an uptick of about 8% after delivering a strong March quarter. Now let's talk about the earnings here. They beat expectations led by improving margins, better profitability and asset quality at multi-year best levels. Now in terms of the management commentary as well, let's talk about that as well, because confident outlook largely is what you're looking at. Portfolio diversification plans further lifting sentiment even as brokerages really flag macro risks as a key monitorable. Moving on, then let's talk about Kotak Securities that upgraded M&M Financial also to a buy and raised its target price to 350 rupees, citing improving fundamentals. The brokerage also says tighter cost control and a core earnings beat in the March quarter have strengthened the company's outlook. Kotak is also saying that this particular company is now better positioned to navigate a challenging year ahead, with operating discipline expected to support profitability even amid a tougher macro environment. Let's move on and talk about something like a Hindustan Zinc that was in focus on the back of reporting a strong set of numbers in the fourth quarter led by robust growth across the board. Now, when you talk about the revenue, that rose about 23%. EBITDA jumped about 27%, aided by margin expansion to nearly 57%. Profit after tax, let's talk about that one as well, about a 29% thereabout increase coming in here, underscoring strong operating performance and cost discipline. Reflecting its healthy cash flows also, the company in fact announced a first interim dividend of 11 rupees per share. Let's also talk about HSBC that has maintained a buy rating when it comes to this particular counter. So they've in fact raised the target price for something like a Hindustan Zinc to 730 rupees from 720. The brokerage is also saying that strong zinc and sulfuric acid prices should help offset higher costs and also weaker silver production. HSBC is also flagging that the March quarter earnings beat was driven by higher volumes and lower operating costs, reinforcing confidence in the company's near-term earnings. Let's also talk about Varun Beverages that has in fact started the calendar year 26 on a very strong note. When you take a look at that 5.5% odd uptick coming in for this particular counter, that should tell you the story here. But when you talk about the earnings fine print as well, it's delivered a sharp beat across key metrics. The revenues risen about 18% thereabout. EBITDA has climbed about 21% as well, aided by margin expansion to 23.3%. When you talk about the net profit, that jumped about 20%, supported by healthy volume growth of over 16% and improved realizations per case. Management, in fact, is saying that strong consumer demand continues to drive performance, while the Twizzler acquisition is expected to unlock meaningful synergies over the medium term, strengthening their growth runway further. Let's also talk about UltraTech Cement that delivered a strong set of numbers in the fourth quarter, driven by strong operating leverage. Profit rose over 20% to nearly 3,000 crore rupees. When you talk about the revenue as well, somewhere close to a 12% growth in the revenue is what you're looking at. EBITDA jumped more than 21%. And when you talk about margins as well, they expanded sharply to 21.7%, reflecting better cost efficiency and price discipline. Backed by healthy cash flows and balance sheet strength, you do have UltraTech that has also announced a special dividend of close to 240 rupees per share, signaling that confidence really when it comes to earnings outlook. Let's also move on and talk about brokerages remaining largely constructive on Paytm despite the RBI cancelling Paytm Payments Bank's license. When you talk about the stock that was down about 1.5%, but Bernstein in fact has maintained its outperform rating with a target price of 1,500 rupees, saying that there is no impact when it comes to the core business or financials. And no further one-offs are expected after earlier write-offs. When you talk about the word coming in from Jefferies, in fact, they've reiterated their buy call with a target price of 1,350, also noting that all Paytm services continue to operate. And both of these brokerages, interestingly, are saying that the move could even enable Paytm to offer certain payments and credit products more flexibly going forward. Let's also talk about Fintech firm One MobiKwik Systems that has received approval from the Reserve Bank of India. And this is for a non-banking financial company license, or NBFC license simply put, marking a key step in its expansion into regulated lending. The license in fact allows MobiKwik to launch an in-house lending arm offering secured and unsecured loans to consumers and small businesses, with a focus also on underserved markets. And the company is saying that the move is going to be helping them roll out credit products faster and improve margins by internalizing lending operations. Shares jumped up to 14% after the announcement, ended the day with that close to 11% uptick also coming in. Lending operations are going to be beginning only after the final regulatory conditions are met. But of course, the street was cheering this one. Let's also talk about something like a digital insurer, Acko General Insurance, that is preparing for its market debut and has in fact appointed bankers for a confidential IPO filing. The company is targeting close to a $2 billion or $2.5 billion valuation, anything in that range, 2 to 2.5, with the draft prospectus also expected to be filed later this year and listing plans aimed for early 2027. Sources are indicating that this particular issue could raise close to $250 to $500 million with a mix of fresh issue as well as offer for sale likely. When you talk about this particular IPO, it's going to be managed by Morgan Stanley, ICICI Securities and Kotak Mahindra Capital. Moving on, then, the centre is working on a 5,000 crore rupee credit support scheme for airlines under the Emergency Credit Line Guarantee Scheme. And that is going to be as the Iran conflict really continues to disrupt aviation and trade routes. Sources are telling your channel that this will be part of a broader 2.5 lakh crore relief framework for sectors hit by the ongoing geopolitical crisis. Under this proposal, airlines may get access to government-backed loans with up to 90% guarantee cover, with a likely 1,000 rupee crore cap per airline, and also a tenure of 5 years that you're looking at here. Let's also move on and get you some business news. Adani Airport has partnered with Make My Trip to launch an online duty-free pre-booking service for international travelers. The new facility allows passengers to browse and reserve duty-free products before reaching the airport, helping cut down terminal shopping time and making the travel experience more seamless. The service is currently available for eligible flyers at select Adani-managed airports, with plans to expand across the network. Moving on, then, let's talk about India overhauling its trade reporting system to bring offshore rupee trades under sharper regulatory visibility as authorities move to stabilize the currency amid recent volatility. Now, the Clearing Corporation of India, or CCI, under the RBI supervision, is revamping the trade repository to really align with global reporting standards and add new fields that better capture bespoke derivative transactions. This particular move is aimed at improving transparency and price discovery in the offshore rupee market, especially the non-deliverable forward segment, which has a significant influence when it comes to the currency. Let's also talk about TCS and Siemens Energy that have signed 2 fresh agreements to deepen their long-running partnership with a sharp focus on AI, industrial, digital transformation, and data center infrastructure. Under this particular arrangement, TCS is going to be continuing as Siemens Energy's preferred IT partner globally, also supporting digital engineering enterprise platforms as well as automation services. Now, this is a key leg of the deal that also involves Siemens Energy India supporting TCS's Hypervolt AI-ready data center business, especially on power, electrification, and grid solutions for high-density AI workloads. Let's also talk about Amazon, that is sharply stepping up its quick commerce play in the country, with plans to take Amazon now to about 100 cities. The rollout is going to be covering key metros as well as Tier 2 and 3 cities, including Lucknow, Kochi, and Vishakhapatnam, as the e-commerce giant intensifies competition with the likes of Blinkit, Instamart, and Zepto. To support the expansion, Amazon is going to be building over 1,000 micro-fulfillment centers. And this is backed by a 2,800 crore rupee investment when it comes to logistics and last-mile infrastructure. Let's also talk about the government ordering to block online content that has surged sharply in 2025, rising to about 24,300 takedown directives. So far, according to a report, more than half of these orders were directed at X, formerly Twitter, making it the single largest platform impacted. The actions are being taken under Section 69A of the IT Act, which really allows the government to block content on grounds including sovereignty, defense, public order, and prevention of offenses. When you talk about this particular report, it's also indicating that authorities may be considering expanding blocking powers to more ministries beyond the current MeitY-led framework. Let's also talk about OpenAI, that is reportedly working on an AI agents-powered smartphone with mass production likely to begin in 2028. According to the report, the device could move away from the traditional app-based interface and instead rely on AI agents that understand user context and complete tasks directly. Now, when you talk about this particular smartphone, it's set to feature a combination of on-device AI processing and cloud-based intelligence, allowing smaller tasks to be handled locally, while heavier workloads shift to the cloud. Let's get you some national news now. India and New Zealand have formally signed a landmark free trade agreement. Now, this is a move that is aimed at boosting bilateral trade, investments and market access amid heightened global uncertainty. This particular pact is providing duty-free access for Indian goods into New Zealand, with reports indicating that over 8,000 Indian products will benefit from zero duty entry. From day one, the agreement is also expected to bring in nearly $20 billion of investments, and this is over the next 15 years, while strengthening services trade and mobility opportunities. Now, in a major political development, Rajya Sabha Chairman C.P. Radhakrishnan has formally accepted the merger of 7 Aam Aadmi Party MPs with the BJP, significantly altering the numbers in the upper house. When you talk about this particular move, it's raising the BJP's tally to 113 seats, while the AAP's strength falls sharply to just 3 members. Now, the defectors include high-profile names such as Raghav Chadha, Harbhajan Singh and Sandeep Pathak, most of them elected from Punjab. Let's also talk about PM Modi, who's scheduled to launch projects worth 6,300 crore thereabout in Varanasi and inaugurate the Ganga expressway in Hardoi as well. Now, the initiatives, let's talk about them as well, because they include infrastructure, urban development and connectivity projects aimed at boosting growth in eastern Uttar Pradesh. Now, the Ganga expressway is a major expressway project that will improve connectivity between Prayagraj and Hardoi, and these launches are part of the government's continued focus on accelerating development in the region. Let's also move on and talk about Skyhop, that has received DGCA clearance for India's first commercial seaplane operations. The company is going to be beginning seaplane services connecting key locations, starting with routes in Gujarat and Maharashtra. The approval, in fact, is marking a significant milestone in the government's push to develop seaplane services for tourism and regional connectivity. Skyhop plans to use modern seaplanes that can operate from both water and land, offering faster and more scenic travel options. Let's also talk about the Narcotics Control Bureau that has launched the Operation Wipe to crack down on the illegal online sale of pharma drugs. The operation targets websites and platforms selling prescription medicines without valid licenses or even prescriptions for that matter, and CB officials conducted raids across multiple cities and seized large quantities of banned and controlled drugs. And the agency is also saying that the illegal trade poses serious health risks and contributes to drug abuse. Let's talk about the IMD in terms of their warning, and they've issued a heat wave warning for northern and central India, forecasting severe hot conditions and warm nights in the coming days. Temperatures are expected to rise significantly in states like Rajasthan, Punjab, Haryana, Delhi, Uttar Pradesh and Madhya Pradesh. Now, the IMD has also warned of warm night conditions which could increase discomfort and health risks. And this is, for people, especially the elderly and children, that have been advised to stay hydrated, avoid outdoor activities during peak hours, and take necessary precautions to prevent heat-related illnesses. Let's also get you some international news. Then diplomacy appears to be back on the table, and a breakthrough seems possible. And that's something that you're looking at because, you do have a 3-stage formula that you're looking at in terms of Iran sharing it to finalize negotiations. First stage of negotiations focuses on the complete end of the war and obtaining guarantees to prevent its resumption against Iran and Lebanon. Now, the second stage will be dedicated to examining the manner of managing and also administering the Strait of Hormuz. The third phase relates to the nuclear issue. Meanwhile, US President Trump, in fact, has also hinted that war might end soon. He's also said that mounting military and economic pressure has placed Tehran in a weakened position and may push it towards a resolution. Let's also talk about Iran issuing a stark warning to Gulf nations following fresh threats from US President Trump as well. Tehran is saying that any damage to its oil infrastructure is going to be met with a response 4 times as severe. Targeting countries that back Washington, the warning comes as talks remain stalled and the conflict risks widening across the region, with energy assets also firmly in the crosshairs. And on more updates on the Middle East war, then, an Iranian MP has openly questioned Pakistan's role as a mediator, and the lawmakers saying that Pakistan lacks the credibility needed for such high-stakes negotiations and is not a suitable intermediary as well. He's also alleged that Islamabad tends to align with US interests, raising concerns over neutrality at a crucial diplomatic moment. Let's also move on and talk about some preliminary findings that suggest that US President Trump was the likely target of a shooting attempt at the White House Correspondents' Dinner in Washington. And Acting Attorney General Todd Blanche is saying that investigators believe that the attacker was targeting members of the Trump administration. US media, in fact, have identified the suspect as 31-year-old Cole Thomas Allen from California, who's not cooperating with authorities. His motive remains under investigation. The reports say that he left behind a lengthy manifesto that was about 1,000 words thereabout. President Trump has since, claimed that the attack was religiously motivated and strongly anti-Christian. Let's also move on, and Lashkar-e-Taiba commander Sheikh Yusuf Afridi has reportedly been killed by unknown gunmen in Pakistan. The incident adds to a series of targeted killings involving militant figures in the region. While details remain limited at this point in time, the development is likely to raise fresh questions around security and internal dynamics. And with that, it's a wrap on this edition of Market Express. Thank you so much for tuning in.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information plates.
Markets show recovery after 3 days of losing streak, with Nifty closing above 24,000 levels today. Sun Pharma tops the chart, up nearly 7%. The broader market outperforms the benchmarks, signaling improving sentiment. No respite for crude prices as ceasefire talks really stall. Brent crude jumps, hovering above $107 per barrel amidst Middle East tensions. Sun Pharma zooms in trade after it signs a definitive all-cash deal to acquire Organon for close to $12 billion. Deal closure is expected in early 2027. Management highlights cost synergy is worth $350 million in 2 to 4 years. Debt of almost $8 billion to be reduced over time. India and New Zealand seal FTA, scrap tariffs on exports and lock in $20 billion investment plan in next 15 years. Piyush Goyal says deal will open new opportunities for the farmers, youth, women and also MSMEs. Government steps in to support airlines amid West Asia crisis. 5,000 crore rupees credit boost likely for the airlines. Emergency credit line framework to back the airlines hit by the conflict. Commerce Minister Piyush Goyal is in talks with the exporters to push the outbound shipments. Key meet to assess Middle East crisis impact. Iran rolls out a 3-stage plan to end the war, starting with the Strait of Hormuz, saving nuclear discussion for the end, and Iranian Foreign Minister blames US for talks breakdown as he visits Russia. Big setback for Aam Aadmi Party. Rajya Sabha chair approves the merger of Aam Aadmi Party faction. 7 former MPs merge with the BJP. Minister Rijiju welcomes MPs. Raghav Chadda trains guns on Kejriwal. Skyhop Aviation receives air operation certificate, set to launch India's first scheduled seaplane services. Hello and welcome. You've tuned into Profit 360. I'm Nisha Podar. Over the next half an hour, we will be taking you through all the top stories and the developments of the day. Let's first begin with the markets. While the stock markets really gained in trade today, as the reports really suggest that Iran sent a peace proposal to the US to end the raging war in the Middle East. While the Nifty held its ground above 24,000 levels, well, the Sensex, it advanced over 700 points in trade today, unlike the case really seen on Friday. Now, most of the sectors ended in the positive zone, with Pharma really leading the charge. And my colleague Jasmeet is right here to take us through the market action for the day. Jasmeet, tell us.
Well, thank you for that. A good day for markets indeed. Well, Nifty 50 gains along with mid-cap 150 and small-cap 250. And Nifty 50 gains about 0.8% and ends about 24,000 mark. In terms of top gainer, we have stocks like Sun Pharma, which has gained the most, up about 7%. If you look at the broader market has outperformed the benchmark, showing a strong sentiment across the market. Now, in terms of mid-cap 150, it has gained about 1.5% and also snaps the 2-day of losing streak and gains 2 days in trade. While in terms of top gainers in mid-cap 150, we have stocks like M&M Finance and NTPC Green, both gaining about 7.5%. Now, in terms of small-cap 250, when that gains in today's trade, well, snaps 2 days of losing streak and gains about 1.7%. In terms of top gainer, we have stocks like Cohance Life Sciences, which gains about 20% in today's trade. Now, in terms of sectors, all sectors end on a green note, with Nifty Pharma and Nifty Realty gaining the most in today's trade. While Nifty Pharma has gained about 2.5%, while Sun Pharma being the largest gainer in Nifty Pharma. In terms of Nifty Realty, when that has gained about 2.5%, and the top gainer in Nifty Realty is stock like Anantaraj, which has gained over 8%. If you look at the other key sectors like Nifty IT, Nifty Auto, Nifty Bank, even they snap the 3 days of losing streak and gains today in trade.
All right, Jasmeet, thanks so much for giving us the market roundup. So even though the equity markets really got pumped up because of some peace talk, well, there was no respite seen when it comes to the crude oil prices of Iran really sending a peace proposal to the US to end this war. Now, the oil prices, they increased by over 2% as Brent oil futures really exceeded $107 per barrel. Now, US West Texas intermediate futures that with June delivery also rose over $96 per barrel. Clearly, the lack of a vivid progress is really tightening the market every day and also pushing the oil prices to its higher levels. Well, let's also take a look at the rupee momentum, and the rupee too remains under pressure today, walking a tightrope around the 94 per dollar mark. The currency, remember, especially feeling the heat of importer really hedging triggered by stubbornly high oil prices. So oil prices are really impacting, and of course the FII outflows is also a big dampener for the rupee. Well, and market voice Jeffrey Dennis that he raised concerns around the weakness in the Indian rupee and flagged it as a key risk for the domestic markets. He also pointed to crude oil prices as a critical factor to really determine whether markets really turn bullish or bearish. Listen in to a part of that conversation.
With respect to India, I think value is beginning to develop in India. The problem India's got right now is we're not sure what the trigger is, and obviously the weakness of the rupee, which is very different from what's been going on, say, with the Brazilian real or the Mexican peso in 2026, is a source of concern. It's a problem for the Modi government. So I think you need better news on the currency, and you need some sort of trigger in terms of foreign inflows coming in for this very, very much underperforming market to do better.
All right, that's the view coming in on the Indian markets. But remember, the overseas or cross-border M&A, our biggest in the recent times, got announced today. So shares of Sun Pharma really jumped nearly 7% during the early trade today after it announced the acquisition of New York listed Organon and Company, and this is an all-cash transaction with an enterprise valuation of $11.75 billion. Now, in an interview with us, well, the company's management highlighted that the Organon acquisition is expected to strengthen its business, especially in the fast-growing biosimilar segment. Now, remember, Organon is already the 7th largest player in the market, and Sun Pharma plans to really build on that particular position. Listen in to a part of that interview that I had earlier in the day today.
We will generate certain cost synergies.
Yes.
And this cost synergies, close to about $350 million, will get generated over a period of 2 to 4 years. And in my opinion, there are a large number of sales synergies, which right now we are evaluating, and it will help business to grow further.
Yes.
And it will help to grow all 3 business segments.
Yes.
As in, like Organon has an innovative business, then they have biosimilar, and they also have established product business. So in all 3 business areas, I'm looking at how do we grow. I cannot give an exact time when we can bring this growth back to the track, but the effort is to do at the earliest possible date.
So like the cost synergies that have been mentioned, Jayashree, is $350 million in 2 to 4 years. There are revenue synergies that are estimated, and then the growth outlook, which you have not put a timeline on.
Right, yeah.
All right. So, Jayashree, when we talk about the cost synergies, you've given the timeline. You said the debt EBITDA levels, and that is 2.3x, which you are comfortable with. Dilip Sanghvi also stated that there is high debt and high risk, and I'm a risk taker. But I want to ask you one question. When it comes to corporate finance, debt equity is a very important factor in getting the required cash flows and generate the growth capital also by debt or equity. It is around 6 times back of the envelope calculation. How are you going to really, give a rationale to such a high level of debt of 6 times of your equity, and also deal with the finance charge at the moment with the huge amount of debt? Because even though EBITDA accretive EPS accretive, you're saying, but from EBITDA to PAT, a lot will be eroded in terms of finance charges.
Okay, here's a good question. Let me answer it in two ways. One, both these companies, Sun and Organon, are cash generating entities. Together, at a pro forma level, they generate about $2.5 billion in terms of cash. And with the growth opportunities that we just spoke about and the cost synergies, the cash generation would only increase over a period in time. With all of this and a very disciplined approach which Sun is used to, we believe it would be sufficient to look at debt repayment at a decent period in time.
All right, that was Sun Pharma. Now, Cohance Life Sciences, that has announced the appointment of Umang Vohra as the chairman and as the group CEO. And in fact, Vohra, the former CEO of Cipla, joins the organization to spearhead its next phase of transformation and also growth. Varsha is here to take us through what it really means for Cohance and the development going forward. Varsha.
Very positive and big news for Cohance Life Sciences, and this is a shocking news. I mean, Umang Vohra joining Cohance Life Sciences. Well, you know why this is an important one, and why you're seeing such a huge surge in stock prices. One is why Umang Vohra is a strategic fit for Cohance. One is he has a proven ability, to grow globally while protecting margins. What he has done with Cipla, and also talking about the customer-centric CDMO segment, we've seen a clear shift from volume manufacturing to value partnerships in Cipla, and also this appointment supports Cohance transition to professional governance-led growth, which Cohance has been doing, and also the track record enhances investors' confidence and strategic clarity. Now, why I'm saying this, what Umang Vohra has done with Cipla, how he has transformed Cipla from 2016 to 26 is one is he has transformed this company from volume to value growth, pivoted away from commodity generics to complex and specialty products, built scale and leadership in respiratory and chronic therapies, and focused on high barrier differentiated products. And the key outcome of all these initiatives taken by Umang in Cipla was Cipla became the world's largest inhaler seller by volume, ranked among the top players in US inhalation generics, and established global leadership in respiratory care at industrial scale. So, a very big and positive news on Cohance Life Sciences, and I think this may be the start of the rally that we are seeing.
All right, thanks Varsha for taking us through all the details. Now, ACCO could be really gearing up for a big market debut. According to sources speaking to NDTV Profit, ACCO has really reportedly appointed bankers to manage a confidential IPO filing. The company is set to be targeting a valuation in the range of $2 to $2.5 billion. My colleague Jasmeet joins in with all those details. Jasmeet.
Well, thank you for that. As rightly said, as per sources, ACCO is planning for an IPO worth rupees 2 to 2.5 billion at a valuation, while ACCO is expected to be picking up bankers to discuss further on the IPO. And we might expect the DRSP to come out in the next few months, and the listing is targeted the early of FY 2027. So we have seen 2026 to be a weak start for the IPOs, but the expected timeline for ACCO is in the 2027, the beginning of 2027, next 12 to 18 months to the max. If you look at few market investors that are backed this particular counter, they are like CPP Investments, and you also have something like an Amazon, which is backing this particular counter. Now, if you look at the other key details, this move is coming amid when there's a demand for the overall digital insurance and how the digital risk is increasing on the back of that AI. Now, if you look at the key financials, the FY25 financials for the company saw a good jump of nearly 35%. It stands at 2,800 odd crores, while it's a wait and watch of what are the further details and at what exact value does ACCO come out with its valuation, with its IPO, and further how will the overall street like the particular IPO.
All right, thanks so much, Jasmeet, for that. Now, India and New Zealand, they have signed a free trade agreement aimed at boosting the bilateral trade investments as well as market access. Now, with trade expected to really double over the next 5 years between the two countries, calling the pact a reflection of a strengthening economic partnership between the two nations. Now, the Commerce Minister on this particular point, Piyush Goyal, said that the agreement opens new pathways across agriculture, agriculture, manufacturing, technology, education and services, describing it as a historic day. And New Zealand Trade and Investment Minister today also said that the deal will drive growth and new opportunities for India, while giving Indian exporters will really have access to the New Zealand market from day one. Listen in to what Piyush Goyal said on this particular occasion.
It is a comprehensive framework spanning market access, agri-productivity, investment and mobility, designed to benefit manufacturing, farmers, artisans, MSMEs, women entrepreneurs, students and skilled professionals across both nations. Take services and mobility. New Zealand has committed market access in 118 sectors and MFN, most favored nation, in 139 sectors, while opening dedicated work, study and holiday visa pathways for our professionals, students and young travelers. For our farmers and rural economies, the Agricultural Productivity Partnership raises productivity, incomes and exportable surplus. The Mutual Recognition Agreement in Organics will boost our organic exports to New Zealand. On the investment side, this agreement is expected to channel $20 billion US.
For New Zealand, strengthening our relationship with India is a key priority. Indeed, our Prime Minister, Christopher Luxon, when in opposition, made a statement to the nation saying that if we were elected to government, our relationship with India would become a strategic priority for the New Zealand government. We see India not only as a major economic partner, but as a country with which we share strong people-to-people links, complementary economies, and a commitment to working constructively together in a changing global environment.
All right, so that was the landmark New Zealand free trade agreement that was signed. My colleague Danish was right there at this particular event and has more details on what it really means for India's trade, Danish, and the expansion of market.
Well, India and New Zealand have signed the free trade agreement in a record time of 9 months. In fact, last year in March, New Zealand's Prime Minister was here in India to meet PM Modi, and at that time only the talks around the FTA had begun. And now we are seeing that on 27th of April, this has been signed here in New Delhi. Well, it is a win-win situation for both the countries. What India gets, well, it will be a major boost for India's exports, as all the goods that are going to be exported from India will attract 0% duty in New Zealand. And since New Zealand hardly has any manufacturing over there, so it is a big field for our entire nation, as not only the automotive sector but the pharma sector, the textile sector, the leather goods industry, these sectors will be seeing a good boost as far as India's exports to New Zealand is concerned. And as far as what New Zealand has to offer to India, well, New Zealand will be investing around $20 billion over a period of 15 years, and within this we also have a lot of boost as far as people-to-people connection is concerned, as there are also talks around student exchange and how both universities in India and New Zealand can collaborate and give a dual degree which can be utilized not only in India but also in New Zealand. Besides that, as far as the temporary visa is concerned for skilled Indians, that is also there. Initially it is starting with 1,500 visa applications, but over a long term it will stretch to 5,000 temporary visa applications. So all in all, if we see, this is a win-win situation for both the countries, and this agreement has been signed at that point in time when we are seeing the West Asia crisis is there and new countries are selecting new partners, and the timing of this FTA agreement is very important, as Indian exporters will now get a new market, that is New Zealand. And very lastly, I would like to add that now, as far as the next step is concerned, this particular FTA will be tabled in the New Zealand Parliament, and there will be debates happening over there, and after a few months it is expected that the FTA will actually begin in full letter and spirit by the end of this year.
All right. Thank you so much, Danish, for putting all that into perspective and getting us those details of the landmark FTA with New Zealand. Now, amid ongoing global tensions, a support package is being worked out as the Iran conflict really continues to impact businesses. A key focus area is the aviation sector, where a 5,000 crore rupees credit scheme is under consideration by the government. Now, as per sources, this proposed scheme will be part of a much larger 2.5 lakh crore rupees framework under the Emergency Credit Line Guarantee Scheme, or ECLGS. Now, this aims at supporting multiple sectors hit by the crisis. Airlines are expected to access funds with a likely credit cap of up to about 1,000 odd crore rupees per airline, and the scheme could really run for 5 years or so, with an option to extend if needed. More importantly, the government may also offer up to 90% credit guarantee cover, which would also reduce the risk for the lenders as well as ensure smoother access to funds. So this is another important measure as we see the Middle East crisis continuing. So let's focus on the war update for today, and diplomacy appears to be back on the table. A breakthrough seems possible as Iran has really shared a 3-stage formula to finalize the negotiations. First stage of negotiation really focuses on the complete end of the war and obtaining guarantees to prevent its resumption against Iran and Lebanon. Now, the second stage will be dedicated to examining the manner of managing and also administering the Strait of Hormuz. And the third phase relates to the nuclear issue. Meanwhile, the US President Donald Trump has also hinted that the war might end soon. He said that mounting military and economic pressure has really placed Tehran in a weakened position and may really push it towards a resolution. So some bit of breakthrough, but at least right now it's all in words. All right, let's take it forward then. Amazon India is set to expand its ultra-fast delivery service, Amazon Now, to 100 cities across the country. It plans to expand deep into Tier 2 as well as Tier 3 markets like Lucknow, Kochi, Amritsar as well as Vizag, backed by a 2,800 crore rupees investment. Now, Amazon plans to build over 1,000 micro-fulfillment centers to really power and also the deliveries within minutes. And this platform will offer over 1 million essential items, groceries, as well as electronics at your doorstep in record time. Now, this move signals Amazon's aggressive push to quick commerce in India's rising competitive market, with Blinkit and Instamart and Zepto already posing a competition and really going ahead in the quick commerce thrust. So Amazon really jumping into this particular heightened competition. All right, moving on, Uttar Pradesh's 594-kilometer long Ganga expressway is linking Meerut and also Prayagraj is set to be inaugurated on 29th of April. So later in this particular month, it will cut travel time to just 6 hours between the two cities. Built by Adani Group, the Greenfield Expressway features world-class infrastructure. Take a look at the report for all these details of this project.
West meets east in Uttar Pradesh. Meerut and Prayagraj just got closer. Yogi government's latest gift to Uttar Pradesh, the Ganga Expressway, set to be inaugurated by Prime Minister Modi on April 29th. This 6-lane high-speed corridor connects Meerut to Prayagraj, halving the travel time to about 6 hours. The Ganga Expressway runs through 12 districts, enhancing connectivity across Uttar Pradesh. India's largest greenfield expressway, 80% of it has been built by Adani Road Transport Limited, a subsidiary of Adani Enterprises Limited. The Ganga Expressway is a 594 kilometers long, 6-lane expressway that is expandable to 8 lanes. It will connect 12 districts, 519 villages, and 8 crore people. Adani Roads Limited has developed 80%, that is 464 kilometers, while IRB Infrastructure Limited has developed 130 kilometers. The total cost of the project is about 36,000 crores, and it has been completed in a record time of 3 years and 3 months. Named after the river that has sustained one of the world's most fertile and populous agrarian regions, the Ganga Expressway will be a booster shot to the region's economy by improving connectivity and productivity. The Ganga Expressway is expected to generate roughly 3 lakh direct and indirect employment opportunities. The Yogi government is establishing 11 industrial corridors across all 12 districts on the route. Meerut, Hapur, Bulandshahr, Amroha, Sambhal, Badaयूं, Shahjahanpur, Hardoi, Unnao, Rai Bareli, Pratapgarh, Prayagraj, which will create millions of jobs over time. The expressway will also be a multiplier for the state's spiritual tourism economy, as it connects 7 major tourist destinations: Garmukteshwar, Kalki Dham, Bela Devi, Chandrika, and Triveni Sangam.
Ganga Expressway starts from Meerut and ends to Prayagraj, and the distance between these two cities by car takes around 10 to 11 hours. But after the inauguration of this Ganga Expressway, the time from Meerut to Prayagraj will be reduced to around 5 to 6 hours. That means the time from Meerut to Prayagraj will be half, but the comfort will be doubled. And if we talk about Ganga Expressway, this is 594 kilometers long expressway, which is made by Adani Group. The 3/4 section of this Ganga Expressway is being made by Adani Group. And if we talk about the facilities, then there are total 9 facility centers, which will include petrol and diesel pumps, and also CNG, EV charging point, cafeteria, food court, dhaba, as well as motel. And there are so many other facilities which will be provided to the car users and the truck drivers on this expressway.
The state-of-the-art expressway has 437 underpasses, 21 flyovers, 76 minor bridges, 20 plus EV charging stations, world-class amenities such as food courts, fuel stations, motels, cafeterias, shopping plaza, vehicle service centers along the way. The expressway will also have 24/7 CCTV surveillance and trauma centers. There is dark fiber for even faster internet. The Ganga Expressway is a shining example of the Adani Group's commitment to the UP growth story. The group has invested in UP across transport, energy, airports, gas distribution, digital infrastructure, cement, and renewable energy. Bureau Report, NDTV.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel.
Presented by Canara Bank. Together we can.
Hello and welcome to Know Your Company. I am Mahima Vachharjani and today we are going to talk about a very interesting company. It's called Rashil Decor. Now why is this interesting? Because this is one of those companies that is into and one of the leading manufacturers, by the way, of MDF boards as well as laminates in India. Not just in India, they're expanding in terms of geographies internationally as well. Now they've got 100+ years of lineage when it comes to wood engineering. In terms of the products that they make, they've got a very big experience coming in. Recently they entered into manufacturing of jumbo laminates as well. This is going to be one of the key drivers for them going forward as well. It's one of the third largest market share. It has one of the third largest market share in terms of MDF boards in India right now. In terms of the overall experience in terms of both of these products, their main key hero products, 32 years plus of experience in MDF boards as well as laminates is what the company holds. In terms of the product range, they've got 1200+ designs when it comes to both of these products, that is MDF boards as well as laminates. In terms of the product range, in terms of brands, they've got 6 distinct brands. Even in terms of the applications of these products, it's used across commercial as well as residential furniture, also used in wall paneling and others. So it's got varied range of areas in which all of these products are used. Now it of course is seeing increase in focus of value added MDF boards, plus considering that housing development is going to pick up going forward, they're in for a huge growth coming in as well. In terms of distribution, they've got 700+ direct distributors. In terms of retail distribution also, if we can pull that number up, they've got 4,700+ retailers and dealers present right now as a whole. In terms of manufacturing, they've got 6 manufacturing facilities across India, of which the breakup is that 1 MDF plant is in Andhra Pradesh, 2 of their MDF plants are in Karnataka, and they've got 3 laminate plants in Gujarat. They've also now recently, the entire unit of, jumbo is also started. But before that, let's take a look at the installed capacity and capacity utilizations as well. For laminates, the installed capacity is 34,92,000 sheets per annum. The utilization for this one as of 9 months FY26 stood at 89%. For MDF boards now, the overall capacity stands at 3,30,000 cubic meter per annum, and the capacity utilization here stands at 72%. They are of course planning to scale in when it comes to the capacity utilization. We'll ask the management about the same. In terms of total capacity for jumbo laminates manufacturing platform, that is around 28 lakh sheets per annum. This is a very recent one that they've opened in Gujarat, the plant for this one in 3 different phases. And the jumbo laminates has opened key access to key Europe markets as well. So this is something that is going to expand their international horizon. Now VIR as a brand has also expanded across 57 countries. So that is also one of the key developments that we'll be tracking for the company. In terms of certifications and quality, that also supports their export growth. So all of these 3 points that I mentioned are very important when it comes to their international expansion and accessing the global markets. Plus, the product quality and manufacturing certifications give them an advantage in driving export sales growth, and that is going to be one of the key factors that leads to their key growth going forward as well. Now let's, this is everything that you need to know about the company. Let's also take a look at the parameters that we're going to look at and assess the company for Rashil Decor as a whole. Let's try to pull that up and see in terms of what parameters are we going to take a look at. The first one that we're going to keep an eye on is the income statement. We're going to talk about how the company has done in the past year in terms of revenue, EBITDA, margins, as well as PAT. The next one that we're going to talk about the balance sheet as to how healthy it is in terms of its borrowings, its cash positions, as well as in terms of where the equity stands. Cash flow, we're going to talk about how cash flow from operation has fared over the years and how EBITDA is getting converted into that cash flow from operations. And we're also going to talk about return ratios as to how the ROC of company has fared so far. Then we're also going to talk about the shareholding pattern, whether the promoters have skin in the game, what are FIs and DIs doing with regards to this counter. All of that we're going to discuss in shareholding pattern. Then we are going to talk about street cred. Now street cred is something that will tell you as to how the stock has done over the years. We're going to break that down into different time frames as to what kind of return it has given to its investors. Then we are also going to talk about valuations, because that is an important perspective as to how this particular counter stacks up against its peers and what is the outlook looking like in terms of where the valuation stands. And that's the outlook part also we are going to separately discuss in the 8th parameter, and we're going to talk about as to what is the guidance that the management has given. Now let's take a look at the first parameter, that is the income statement. Now if you take a look at the last 3 years for this counter, the 3-year CAGR, we've taken FY25 up to FY25 numbers for simplicity of understanding. 3-year CAGR in terms of revenue stands at 13%, but if you take a look at the last 3 years, the revenue has been range bound in that 800 to 890 odd crores. EBITDA has also seen a similar CAGR of 13% in the past, three odd years. And what we're seeing is that overall revenue as well as EBITDA both are growing hand in hand. But PAT overall, if you can go back to the previous slide once, overall in terms of the PAT numbers as well, we've seen a good growth of 28% when it comes to the 3-year CAGR, but the last 2 years the PAT has largely remained in that 40 to 45 odd crore range. Let's take a look at the margins as well. Margins is something which is concerning because that's dropped from FY23 to FY25 from a 17.8% to 11.8%. This we're going to talk to the management about, but I think the main concern here is with regards to the rise in raw material cost inflation, and I think that is the reason as to what is putting pressure on margins. And plus I think probably they're going ahead and spending in marketing spends as well. We'll try to understand, of course, that part from the management. But overall, in terms of the overall CAGR plus the margins, considering margins into picture, we've given it a neutral rating when it comes to the income statement. Let's take a look at the balance sheet as well. In terms of the overall picture when it comes to the retained earnings, that has grown steadily over the past 3 years from a 344 odd crore to a 600 odd crore in FY25. So that there is no problem there, completely a thumbs up. In terms of the debt, that has been reducing, both considering both the long-term and short-term debt. It stood at around 400 odd crores in FY23, gone down to 267 odd crore in FY27. This combines both long-term and short-term borrowing. We'll try to understand from the management as to what are their plans going forward when it comes to debt reduction. Cash in bank is the other factor which is slightly concerning, because overall their average cash flow has remained in that range of 5 odd crores. So we'll try to understand from the management whether they're planning any fundraise, and apart from that, what are the plans to retain cash going forward. Because if you take a look at the cash flow picture as well, I will try to understand as to how the net cash flow position has remained zero throughout the years. They've overall managed to grow in terms of their operating cash flow to EBITDA number, which is a healthy number for sure, from 77% to 102%. But overall, slightly in terms of cash flow from operation has been reducing a tad bit, and the net cash flows have remained zero, which is not a concern when there's conversion happening in terms of EBITDA number. But overall, we try to understand from the management with regards to what are their plans are when it comes to the cash position. But because the ratio is healthy here, we've given it a thumbs up when it comes to the cash flow statement. Let's now try to understand the ratio aspect and see as to how return ratios have fared over the last couple of years. Let's try to look at that chart. It's an interesting one. It went to 16% ROCE in FY23, but since then it has come down. It's come down to 12% in FY24 and 10% in FY25. So we'll try to understand from the management as to what the internal targets are to grow that ROC percentage. And because of it declining in the past 3 odd years, we've taken a conservative approach here and given it a thumbs down when it comes to the return ratios. Let's try to pull up the shareholding pattern. Now, the promoters have largely held their stake in the company, so there is skin in the game. It is above 50% mark. So overall, that has remained largely stable in the past 3 years. When it comes to the FI holding, not much of an interest for FIs and DIs both here, because FIs have largely maintained their 1.2, 1.3% stake in the company. However, there's public holding which is very strong on this one. 42% to 44% it's gone in the past 2 odd years. Because there is no FI DI interest that we've seen in this counter, of course it's also a very small market cap company of around 500 odd crores, and that is why probably we're seeing less FI DI interest. But considering that approach, I think we've given it a neutral rating for now. This is the number of shareholders that have grown in the past 3 odd years, from a 24,000 number to a 50,000 or 74. This is of course in terms of thousands. Let's try to pull up the next slide and see as to how the street cred has been right now. Interestingly, in the past 1 month, the stock has gone up almost 22%. But if you take a look at the performance from a larger scale, 6 months it's down 39%, YTD it's down 28%. 1 year, the stock is down 29%, and 5 years, it's not done anything. It's just given return to its investor by about 5 odd percent. Considering that, I think we've given it a thumbs down for now, but we'll have to wait and watch out for whether that 1 month move that we've seen in the past 1 month will continue in terms of momentum or not. So that's with regards to where street cred goes. Now let's take a look at the outlook picture as well, because the management has given guidance when it comes to FY26 as well as FY27 going forward. But before we do that, let's take a look at the peer comparison as well. In terms of the peer comparison, Rashil Decor is one of the cheapest stock available right now in this space, because if you take a look at Century Plyboard, that's trading at 72 times, Greenlam Industry trading at 313 times, versus Rashil Decor just trading at 16 times, because Stylum and Greenply are also trading at 27 times and 40 times respectively. So Rashil Decor right now is one of the cheapest stock available in the entire space of MDF as well as laminate. So that's why we've given it a thumbs up when it comes to the valuation, but we'll have to wait and watch out for as to how growth for the company fares going forward, because that will also determine as to how valuations fare. Lastly, in terms of outlook, FY26 revenue, they're targeting around 900 crores. They did around 890 odd crores in FY27, so not much of a growth as compared to FY25. EBITDA margin is expected to be around 8 to 9%, which is slightly lower as compared to what they did in FY25. So we'll ask the management as to what the plans are going ahead. FY27 revenue, however, they're bullish when it comes to the FY27 revenue. 1,000 crores is what they're at least aiming at. Overall, in terms of EBITDA margins, they are expecting this to go up to 10 to 11% from at 8 to 9% in FY26. So this is the overall guidance given by the management of companies. Strong guidance coming in for FY27, and that's why we're giving it a thumbs up when it comes to the outlook. So that's with regards to where, of course, the overall parameters go for the company. Let's now take a look at what ratings have we given for this one in terms of the total overall ratings for Rashil Decor. Let's try to pull that up and see. For income statement, we've given it a neutral rating considering margins declining. For balance sheet, we've also taken a conservative approach here and given it a neutral rating considering the borrowings picture. Cash flow, we have given it a thumbs up because operating cash flow to EBITDA is a very healthy ratio for the company. Return ratio, we have given it a thumbs down because the ratio has been declining when it comes to the ROCE number. Shareholdings, we've given it a neutral rating right now because it's a small company, no FIDI interest. So just a conservative approach is what we've taken. Street cred, 5 years, the stock has not done anything, and that's why we've given it a thumbs down. But of course, we'll be watching out for, because in the last 1 month, there is momentum seen in this counter, and we'll keep an eye on what happens next for the company. Valuations, most certainly a thumbs up, because one of the cheapest stock available in the space at 16 times right now. Going forward will become cheaper as well, but growth is something that we'll be watching out for, and outlook definitely a thumbs up. The guidance given by the management for FY27 is most certainly a bullish one. So that's with regards to Rashil Decor goes. The overall rating comes out to be 4.5 out of 8 for Rashil Decor. So that's with regards to where the final ratings go. But viewers, time to slip into a very, very short break. We'll be speaking to Rashil Thakkar, the managing director of Rashil Decor, on the other side of the break. So do stay tuned.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches.
You're watching Know Your Company, and we were talking about Rashil Decor. We've given the company a rating of 4.5, healthy financials going forward, and healthy guidance also the management has given going forward. And let's talk to, in fact, Rashil Thakkar, the managing director of Rashil Decor, who is joining us now. Rashil, thank you so much for first of all taking the time and speaking with us at NDTV Profit. My first question is with regards to how we've analyzed your income statement. Just want to understand, you've already given FY27 guidance of that 1,000 crore odd mark. In the last 3 to 4 years, there has been a tepid growth, and this I suppose is considering the growth in terms of how industry is going in terms of real estate as well. Plus, there is raw material cost inflationary pressure continuously on you. But what gives you the confidence of achieving that 1,000 crore in FY27? What will be the triggers going forward?
So first of all, good afternoon, and thank you, Mahima, for the opportunity. So as we look to grow towards the 1,000 crore company, so first of all, our jumbo project is now in place, and all the research and development which has to be done has been in place, and we are opening up the markets in Europe and Northern America and Latin America, which will grow our export revenues in laminate. In terms of MDF, we are growing with the value addition. So our target is to reach 50% of the total capacity with the value addition, which will give us another boost in the top line and also in the net margin ratio. So we are very clear with and focused with our vision, what we want, and that's how our company will be growing at this year for 1,000 crores.
Okay, Rashil, with regards to your margins, you've said that you'll do 8 to 9% this year, but that will go to 10 to 11% next year. Considering the West Asia conflict into consideration, that has probably pushed your raw material inflation further, if I'm not wrong. Do you think those margin levels are still achievable in FY27? What is the hit that you've taken in FY26, and what is it that will, be followed through in FY27?
So yes, price hike we have taken in MDF roughly around 15%. Our first hike was in April first week, which was around 10%, and the second hike we took somewhere around 10th of April, which was somewhere around 5%. So, and looking at the current scenario, yes, our prices are sustainable. When we talk about our HPL business, we have roughly taken 18% of price hike in 1mm, which is our premium product, and slightly lower in the lower range of the side. So margins are retainable. Talking about the chemical prices, yes, the chemical prices has gone up drastically, and we are trying our best to procure at the best rate possible and sustain our margins what we have already committed. But speaking towards the margin for this year, yes, we are expecting to have EBITDA margins of roughly around 11 to 12%.
Rashil, with regards to the overall cost price that has gone up for you, just want to get a sense as to how much of West Asia conflict has actually impacted you right now, and will that hit be taken forward in FY27 is what I want to understand.
So currently, yes, our strong markets are Far East and Gulf. Gulf has given us a good hit for MDF exports, but now we have slightly looking towards the other part of the world as well, and we are exploring some more customers. So we are expected just not to depend on one country for our MDF export, just one continent for our MDF exports. And talking about laminate, yes, laminate, we have a vast number of countries, like we are operating in more than 63 countries currently. So West Asia conflict has given us a hit in terms of MDF, but in laminate, yes, we have other trajectories where we are working very strongly. And talking about again coming back to the raw material side, yes, our majority of the raw materials in chemicals come from Gulf, and which has given us a higher impact in terms of cost increase.
So then, Rashil, I want to understand as to what's your difference between, breakup between your exports and domestic sales right now, and how will that fare in FY27? How does that change things, and that, having impact or bearing on your margins?
So first of all, when we talk about laminate, our laminate turnover is 65% from exports. And when we talk about MDF, our 20% average is out of the exports. And combining both together, around 25% of the turnover comes from the exports. That's how the blend of the turnover is. Domestic in MDF is the major part where we are playing, and it is a major part of our top line as well. So considering that, yes, the ratios we will try to increase up to 30% for exports in both the products. That's what our target is.
With regards to your debt, Rashil, that stands at around 139 crore as of FY25. This is the long-term debt that I'm talking about. Any plans of bringing that number down in the near future? I mean, you might have reduced it in FY26 already. So if you can give us a perspective on that number and then going forward in FY27 as well.
So our yearly repayment to the debt for the long term is roughly around 50 crore rupees every year. So considering that we have already paid the 50 crores for this year, so we consider ourselves as a debt-free company in upcoming 2 years.
Rashil, the other aspect is with regards to your cash position, because on an average you have maintained that cash position anywhere between 5 to 10 odd crores. Do you think that you have more requirement in terms of where the cash balance stands, and would you be looking for any fundraise going forward, maybe for that reasons?
No, currently we are comfortably operating with our cash ratio what we have, and in current stage we are not at all looking for any fundraisers from the public or any kind of offerings from the public or any private equity. And we are clear with it that in this financial year we will not be raising any kind of fund.
Okay, got it. Rashil, for your ROCE number that has declined in the past 2 years from that 70% mark to that 10% mark, if I'm not wrong, any plans or internal targets to raise that number going forward? And if yes, any range that you would want to give in terms of how that number will fare in FY27?
So if we compare our ROCE with the FY23, the 23 was something really very good year for us because of certain things. We had a newly installed capacity in hand and everything was online. But when coming years ahead, there were too many domestic competitions started, because of which there were too many internal domestic competition and conflicts going on. Now, it is a time that we are seeing that we'll be growing, but I can't give you the indication at with what percentage the ROCE will be growing. But I would assure you that the current ROCE which we have will be maintained in any case.
So then, with regards to your installed capacity right now for both laminates as well as MDF board, laminates, I think utilization stands at 89%, which is a very healthy number, and so is for MDF boards, which is at 72%. What is your blended utilization at currently right now, and how will that number go going forward in FY27? Because even the jumbo laminates manufacturing is, if I'm not wrong, now fully operational and will start contributing to your overall capacity utilizations.
So in HPL, when we see, we divide it into two parts. One would be the jumbo facility, which we are operating currently at roughly around 25%, which we have targeted to utilize more than 55% this year. Talking about the old facility or old capacity, what we have, we are utilizing at the peak somewhere around 85-88%. And in laminate, there are too many permutation combinations on which the capacities are calculated. So in the older side, we are not expecting that we will be having a long difference between the capacity utilization. It will stand somewhere around 85 to 90% depending on the project, depending on the product mix. In jumbo, yes, we'll be increasing to 55%. Coming towards the MDF, our capacity blended with both the units, Visakhapatnam and Chikmagalur, is somewhere around 87 to 90%. And in our Chikmagalur facility case, we have almost utilized sometimes up to 120% also. So we don't see a capacity concern rising as of now for this financial year, and we are very confident to utilize that MDF capacity to about 90% as well in blended form.
All right. Thank you so much, Rushi, for helping us answer, in fact, all those questions so candidly and taking out the time and speaking with us at NDTV Profit. All right, so that was the management, of course, of Rashil Decor, giving us as to what giving us a perspective of what FY27 is going to look like for the company. The company the share price, in fact, has seen a growth of 22% in the last 1 month. So we'll be watching out for as to how things fare going forward. But with that, completely out of time on this edition of KYC. Do stay tuned for more news and updates on the other side.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market opening. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit. When the headlines move fast, perspective matters. On Editor's Cut, our editor.
Welcome to Your Money Matters. I'm Mahima Vachharjani and you are watching NDTV Profit. Now, today we're going to talk about two very interesting topics. The first one is how to build your mutual fund portfolio from scratch, because our viewers keep sending us queries from asking about very basic stuff as to how many mutual funds should you have in your portfolio, what should an ideal portfolio look like when it comes to doing your SIPs, etc. So we get all of these questions a lot of times. So I thought that let's try to break this down for our viewers in a very simple language and simple terms. And to do exactly this, we're joined by Harsh Kumar, who's the CFA Managing Partner at Zwest Financial Services LLP, joining us now. Harsh, thank you so much, first of all, for taking up the time. Like I said, we get a lot of viewer queries asking that, if I were to build my mutual fund portfolio from scratch today, what should I do? So my first question to you is, from a beginner's perspective, if I were to start building my mutual fund portfolio today, what should be the first aspect that I should look at?
Hi, Mahima. Good afternoon. Thanks for having me. Now, let's first understand lay of the land. So today, if I look at mutual fund universe, they are close to around 580 to 600 schemes in equity category. They are close to around 200 schemes which are in hybrid category, 330 to 340 schemes in debt. And on top of it, we have around 750 to 760 schemes which are available in passive, FOFs and everything. Now, if I add it up, they're close to around 1800 to 1900 mutual fund schemes which are available for any and every investor today. And going through the maze of this is very daunting. Now, before one gets into which funds to get into, the idea should be that one should get into the broader picture of the portfolio. So how should one go about it? Step one should be to understand what are the goals of an individual, what is the time horizon an individual has, and what is the kind of risk appetite one can withstand with respect to volatility in the portfolio. And basis this, step one should be deciding asset allocation. Once asset allocation is clear as to how much should be in Indian equity, offshore equity, gold, silver, other things, then one should get into deciding which funds to have in the portfolio. And that's how one should proceed. Now, this is true for investors who are starting to build portfolio, which have goals which they want to fulfill from the portfolio. But for somebody whose goals are already taken care of, that individual should proceed in a way to optimize return at a given level of volatility that one can tolerate.
Okay, here's the other aspect. A lot of people who speak to us kind of are confused because they end up doing small amounts of SIP in a lot of mutual fund, which eventually go and overlap, right? So what is the ideal number of mutual funds that you should have in your portfolio, and how should this number be diversified exactly?
So, if you would have asked me this question 10, 15, 20 years back, I would have said that, 5 to 6 funds are good enough to do justice to the portfolio. And the reason is in those days, the funds were not true to level. So you could take one large, one mid, one small, one debt fund or one hybrid fund. And you could have seen that you could have got diversification because beyond these funds, if you would have chosen, you would have a large cap fund with a mid cap overlap, mid cap fund with a large cap overlap, and those kind of things. Those were also the days when tracking the portfolio used to be on Excel sheet and which was not very easy beyond 5, 6 funds. But while we speak today, I think the number of funds have to go up. And the reason is that Indian market has evolved and is in the process of evolving. Unlike the Western world where most of the evolution in this space has happened in last 30, 40 years, India is still going through that process. So today, while we speak, one has an option of choosing offshore funds, and one should choose offshore fund because a lot of our expenses are dollar denominated, be it about our Netflix subscription, buying jewelry, buying gadgets, sending our children to outside India in terms of education. We need dollars in the portfolio, and that's why we need maybe one or two offshore funds in the portfolio. Second, if you see the kind of evolution we have seen with respect to the funds which have come up in the market, 10 years back, there was no silver-based fund. We didn't have any quant-based fund. We didn't have this kind of a universe for passive fund. We didn't have smart beta at all. Now, if you want to take advantage of these, you may need maybe one or two funds in this category also. On top of it, large, mid, small, all these funds are true to label now. Now, if you see the number of companies which have got listed in India in last 2, 3 years, that also is the reason that you should have maybe two funds in mid cap and small cap. Because just to give you numbers, in 2025, we had more than 100 companies which came to the main board. In 2024, we had close to around 94, 95 companies which came in the primary market. Now, if you want to invest into newer ideas, you need a lot of research capability, and one fund can't do justice to that. So you need more funds there as well. Lastly, if you see the style, the way they have been panning out for last 4, 5 years, we need more than one fund in each category to offer us different styles. Just to give you an example, if I look at last 3, 4 years, in US market, we have seen growth stocks doing very well. In India, we have seen value stocks doing very well. Now, if you were on the other side with one fund in one particular category, and you would have been underperforming on your portfolio. So if you add all these factors, I think in today's time, having 10 to 15 funds is not a bad idea. But the point here is where you started with, that this should be offering meaningful diversification. So if your portfolios have overlap, if the correlation in your portfolios is very, very high, in layman term, if your funds are going up or down at the same time, then it means you are not diversifying it. So take professional help, see if the funds are truly diversified, and then depending on the complexity in the portfolio, you can take as many funds as it fits your criteria.
Okay, all right. Harsh, the other aspect is that investors keep asking whether to choose SIP or lump sum while building a portfolio. Now, from this, I think my understanding is that SIP is a must. It's a non-negotiable, right? But when it comes to lump sum amount, let's say, for example, by the year end you get a bonus. That's the time you go ahead and invest that lump sum amount as well. How does one, put into perspective this strategy perfectly?
So there are two dimensions to that, and you touched upon that. One is the cash flows of an individual, and second is the valuation in the market. Now, suppose you are in a profession where your lumps are higher than your monthly cash flow. For example, if you are in a startup and you are dependent on your stock options liquidity, then you will get a lump which is going to be far higher than your normal salary. If you are a celebrity, if you are in a profession like you are a cricketer, like you're a sports person, you may get money for 4, 5 times in a year, and you have to manage how to effectively deploy that money. If you are in a job where your bonus is far higher than your monthly take home, then also you are dependent on deploying lumps. Now, you didn't touch upon one particular way of investing, which we can also discuss, which is called STP. Which means you are getting lump sum, you want to deploy it into the market because you know that you are not getting monthly cash flows to do SIPs. If the valuation is good, you can deploy it immediately. If the valuation is little stretched, you can do systematic transfer also, where the money moves to liquid fund and from there you move to equity fund. Now, this is about somebody who's getting lumps, somebody who's dependent on his monthly cash flow for his investment and doesn't rely too much on bonuses or one-time windfall gains. that individual should definitely focus a lot on SIPs, because SIPs not only take care of the volatility of the market, but they also take care of the behavioral aspect. Market is expensive, market is cheap, you want to book profit, you want to, stop your SIP. Those kind of things are generally taken care of if things are automated. So if you ask me, the best strategy is your portfolio foundation can be via SIPs. And whenever there is a market correction like what we have seen in last 1 to 2 months, you can add up or top up with some lumps as well.
Okay, all right. So that, sums it up well, very well, Harsh, that, how should you differentiate and, use both of these strategies hand in hand. The other aspect is as to how do you determine the right mix between equity, debt, as well as hybrid funds. For equity and debt, we've always talked about the age minus 10 rule, right? But when it comes to these hybrid funds as well, how do you, approach it with the right strategy?
So a lot of people say that, 100 minus age should be your equity allocation, but I respectfully disagree to that, because age is just one variable in terms of deciding how much risk you can have in the portfolio, and it's not the only variable. Now, how we would analyze this particular thing? One is I would look at risk in 2 dimensions: ability to take risk and willingness to take risk. And second aspect for me to decide this would be what is the kind of holding period an individual has. So for example, if one has ability and willingness to take risk on the higher side, and the holding period is more than 5 years, then the portfolio can be heavily skewed toward equity. If the time period is 3 to 5 years, then one can have a healthy mix of hybrid. If the time horizon is less than 3 years, then debt-oriented funds can be a major part of the portfolio. On the other hand, if an individual has less ability and less willingness to take risk, irrespective of the time horizon, a debt portfolio or debt-oriented scheme with hybrid should be the major allocation. The idea of the portfolio is that it should not give you sleepless night. It should not become a health issue for you. So you understand your risk appetite and not just your age rule before deciding how much you should allocate across these 3 categories.
Okay. And is diversification across fund categories more important than chasing returns? How does that work?
Definitely, it's very important. So often investors commit a mistake whereby whatever asset would have given return in the previous year, they end up taking lopsided exposure in that. Or even the funds which would have done for last 1 year, done well, they would take higher exposure in that. So I was just going through a study which was done by DSP Nitra, which said they took the data for last 13, 14 years, and they realized that in every 3 years, more than 67% of the fund in each category move from quartile 1 to lower quartile, which means if you're chasing the previous year's good funds or previous year's good asset classes, then you may end up getting disappointed more often than the rewards of that, which may make you happy. So the ideal thing for you should be, you should have your eggs across the baskets. And it doesn't mean having more number of funds, but go by your asset allocation. For example, last year in 2025, somebody who had portfolio only in mid and small cap basis the performance of the previous year would have been disappointed. But somebody who had money in gold, silver, real estate through REITs or in offshore equity would have still beaten inflation in India versus somebody who was only in small cap and mid cap.
Okay, fair. Harsh, the other aspect is if I have and I do SIPs every month, in how much time period should I review and rebalance my portfolio? What is the ideal time period?
So review should be once every 3 months. And rebalance should be either once every 12 months, once a year. You can have a calendar around that. Or if there is too much of volatility in the market and you feel that your asset allocation mix is getting distorted, you can have a rebalance before that also. So ideally, when you decide your asset allocation, you don't decide a single number. You can decide like, I want to have 55 to 65% in equity. I want to have 20 to 25% in debt. I want to have 7 to 12% in precious metal. And if you see that you are deviating from that range, you can do the rebalancing. So you should treat it like a health checkup. You don't get it done every week or every month. You should define a frequency which is once in 9 months, 12 months to take care of these things.
Do you deal with underperforming funds? Do you scrap them off immediately, wait for a while? How does that work?
No, so definitely not. So if there is a 1 year underperformance, it's not that we need to remove that fund from our portfolio. But before getting into the underperformance, you should understand what are the reasons for underperformance and how long has been the duration of underperformance. So I would get skeptical about a fund provided there are 4 or 5 reasons. Say, for example, one, if there is a change in the fund house or fund house's strategy, then I would want to analyze the new strategy and take a call. If there is a change in the fund manager, because of late we have seen a lot of fund manager changing fund houses, then also I would want to review my portfolio. Third, if there is a merger or acquisition of a fund house, then I would want to see what is the ideology of the acquiring fund house and whether I want to continue with that or not. Lastly, if there is a underperformance against benchmark and against peer, which is continuing for a market cycle, then I think you can review that and you can decide whether you want to exit that or not.
Okay. How does an investor avoid over diversification, Harsh?
So there are 2 ways. One is looking at the correlation between the funds. You can check it yourself or you can take professionals' help to decide whether the correlation is high or low. Second is you can look at the overlap of the stocks in different funds that you have. So ideally, high overlap and high correlation means you are not truly diversifying. And like I discussed earlier, if your 2 funds are moving in the same way when the market is going up or coming down, then you don't need those 2 funds. You can do justice with one fund itself.
Okay. Apart from that, Harsh, what are the key mistakes that generally people make while choosing a mutual fund, and how can they get rid of these mistakes?
Remember, first and foremost, the biggest mistake which is committed by individuals these days is they don't believe in asset allocation. So normally individuals go by last year's top performing funds or top performing asset classes, be it about equities or about crypto or about precious metal. They just chase what has been done last 1 year and they start investing in that. That should be avoided. One should have a very, very clear asset allocation framework, because there have been numerous studies, some by even Nobel laureates, which say that asset allocation is the major generator of return over a 20-25 years period, and not the selection of stocks or selection of funds. So these are 1 or 2 important things. Second, when there are corrections in the market, if you end up stopping your SIP, if you end up redeeming your fund, that is again a classical mistake which people do. And on the other hand, when there isn't too much of exuberance in the market, when everyone believes that India is the only place in the world, that's where mistake happens, because you over allocate into India or Indian equity. Lastly, checking your portfolio every day, comparing your portfolio return with your neighbors or friends is again a mistake, because each one to its own. You can't have same return at a different level of risk which the other is generating. So if you follow these 4 or 5 things, where you track your portfolio once every 3 months, have a fundamental approach to asset allocation, you don't chase return, but you chase good quality processes and good quality fund managers, I think your journey over a 10-15 years period can be really rewarding, and it can surprise you on the positive side even more than what you can even imagine.
Okay, Harsh, thank you so much. I think this is going to benefit our investors and viewers who are watching this, build their portfolio from the very scratch, and you help them understand it in a very easy and simple language. Thank you so much for taking out the time and helping us answer all those questions.
Thank you, Mahima. Pleasure is mine.
I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on New York.
Alright, right, so now first we of course talked about how to build your portfolio from scratch, but the other topic that we're going to put spotlight on is gold leasing. How is it done, whether you should do it or not, etc. And to take this conversation ahead, we're joined by Harshvardhan Rungta, who's the CFP at Rungta Securities, joining us now. Harshvardhan, thank you so much for taking out the time. In simple terms, if you were to explain what gold leasing is to our viewers, how would you explain it?
Yeah, hi Mahima. I think it's a very interesting topic because we see gold at all times high right now. And historically, we've known the love that Indians have for gold and particularly physical gold. And, so gold leasing could be a good option for individuals who wish to make some money on ideal gold lying in their lockers. So let's understand this entire concept of leasing, gold leasing with an example. Say, for instance, you have, as an investor, as an individual, you have, say, 100 grams of a gold bar with you, valued at about 15 lakhs currently. And I am a jeweler. Okay, so let's take this example where you are an investor owning, say, probably 100 grams of gold, and I am a jeweler in the business of manufacturing and retailing of jewelry. Now, if I wanted to manufacture jewelry, I would need physical gold, which I would otherwise have to buy. So in option one, I go to the market, I buy 100 grams of gold, I invest that 15 lakhs, and then I make the jewelry and then I retail it out. Alternatively, I come to you and I say that, why don't you just rent or lease, just give me that gold on rent or, oblique lease, as the word would be. I'll manufacture the jewelry, I will sell it off, and the period for which I'm using your gold, I will give you interest on that gold. Say, for example, now you've leased out 100 grams of gold to the jeweler. The jeweler uses that to make a piece of jewelry, sells it out, say, after 1 year, for example. And if the rate of interest is fixed at, say a percentage, say 5%, for example, then at the end of 1 year, I will give you back 100 grams plus 5% interest on it, or I'll give you gold equivalent to the interest part. So for you, it works in such a way that the gold was lying ideal with you. You're putting that to good use and you're earning some interest on it in the form of lease. For a jeweler, the jeweler doesn't have to put in any capital. He gets that money, he gets gold on lease, manufactures the product, sells it, and pays only interest for the carry that he's going to use that gold for. So that is the entire concept of gold leasing in simple terms.
Okay. Harshvardhan, what is the general interest rate that we get on gold leasing? What is the traditionally accepted rate that we generally get?
So, well, Mahima, this is a product where, the interest rate would not be very high, particularly because it is going to only help an investor who owns gold to earn some bit on it.
Correct.
So I'll draw parlance with sovereign gold bonds. Okay, I'll just draw parlance with that. Where sovereign gold bonds say that if you're invested into gold, the government of India will pay you 2.5% interest. The idea is not to earn interest on this. The idea was to just incentivize investors to not hold physical gold, but go for paper gold. Now come to this gold leasing concept. Now it largely depends. The interest rate largely depends on the credit worthiness of the borrower. In this case, the jeweler. So if a jeweler is, say, a very large branded jewelry brand which is trustworthy, they will certainly pay you a very low interest rate. Now, in case of somebody who's a local jeweler, not very popularly known, so you might also hesitate to give gold to him on lease. So in that case, the interest rates would be high. So I guess investors in this particular segment should assume that they'll get an interest of, say, about 3 to 4%, in some cases, say 5 to 6%.
Okay, I got it. The other aspect is, Harshvardhan, with regards to, how this can be done. What is the exact procedure? Because I believe that there are various apps and websites available today to do this, as well as, the traditional way of going to a jeweler and actually giving your gold. So what is the right way to do this, the entire process, if you can give, perspective from that to our viewers?
So the first thing you need to be careful about is that it is not a regulated market. It is not a market which SEBI regulates or RBI regulates. There's no formal rules and do's and don'ts about it.
Correct.
Okay, where RBI is concerned, RBI regulates the banks. So all those banks who are holding gold in their books may want to possibly lease it out to known jewelers, and that is what RBI will possibly try and only control. Wherein retail investors like you and me are concerned, there is no formal network or a setup in this particular context, wherein there is a market for it, there is a grievance redress mechanism, there is nothing of that sort. So it's more to do with your personal comfort level with a jeweler. Say, for example, if a Tata Group or a Tanishq is borrowing, I think the whole of the country will be very comfortable doing it, right? But if there is a local jeweler in some lane, by lanes of some your colony, it is going to be more on the relationship that you have with the jeweler and the confidence you have that that person will return it back to you. So I think do's and don'ts, what to be careful about is one. As an investor, be very clear that there is no formal regulator for this particular product. It is more on a one-to-one basis. It's the risk that you are willing to take. If there are some platforms online which are facilitating this transaction, it is only purely based on a business commercial transaction. Now, as an investor, what you need to be sure about is that if I'm using a particular platform to lend gold to a particular jeweler or somebody on the other side borrowing, who is the counter guarantor in this particular transaction? How is the platform ensuring that the jeweler is going to return the gold back to you? So there could be several mechanisms like a bank guarantee. There could be XYZ arrangements that they could have a collateral which would be given possibly by the borrower. So you'll have to figure out what is the security in case there is a default by the person taking your gold. So there has to be some mechanism. Now, if you're looking at only the criminal proceedings with the police, I mean, that could be lengthy, that could be by itself an exercise. So just be careful as to, in case you don't get your jewelry or your gold back, what is the course of recourse? What is the recourse for you to make sure that it is least troublesome for you to get it back? As I said, there is no formal regulator in this entire transaction. So you'll be by and large left to the criminal proceedings to be initiated by the police.
In terms of the volatility in gold prices, will that impact your gold leasing decision in any way?
So as an investor, no. So if you're an investor, for example, and as I said, if you had 100 grams of gold, which you're leasing it out to a jeweler, what you're going to get back at the end of the lease period is your gold back in the same quantity or the interest converted into gold. Say, for example, you give 100 grams of gold. At the end of 1 year, if that is your lease period, you will get back 100 grams of gold plus the interest. Now, interest could be in rupee terms or it could be in gold format itself. Now, for the jeweler, it works well. For the jeweler, why it works well for them is that if I was a jeweler again, I buy jewelry, I buy 100 grams of gold at 1,50,000 rupees. So I've invested 15 lakhs. And if the gold prices were to go down, so it crashes down, and after 6 months, I'm selling the jewelry and it is at, say, 1 lakh, for example, then my cost of acquisition of that jewelry is 15 lakhs and I'm going to sell it at 7.5 lakhs. So when I have to come back and return gold by gold itself, then I'm only going to return gold in 100 grams, which I've taken. So for me, I get protected against the pricing. At the same time, if it goes up, if the gold prices go up, even then I'm immune to the whole thing, because if I'm going to sell 100 grams worth of gold after 1 year, I get the sale proceeds after 1 year at that then market price. I buy gold at that future market price itself and I give it back to the lender. In this case, you who's going to lease out the gold. So for a jeweler, it reduces the capital requirements because I'm not putting in the money right now. I'm not putting in actual 15 lakhs to buy 100 grams right now. I'm only going to be giving a cost of using that, which is the interest that you may talk about, which I said would be say about 5 or 6% for that matter. So it is an equation more so if the price volatility is concerned, it's more for the jeweler to protect the price volatility. As far as the investor is concerned, you're going to give 100 grams, you're going to get back 100 grams. So whatever is the price at that point in time of giving it or getting it back doesn't really matter to you.
Okay, Harshad, thank you so much, for helping us explain as to how investors can use this and probably make some more returns on gold. But also, viewers, keep in mind that, as Harshad mentioned, that this is not a regulated thing. So you do have to keep in mind the risks as well. Thank you so much, Harshad, once again for taking out the time and helping us understand what gold leasing means.
Thank you, my pleasure.
All right, viewers, with that, we're completely out of time on this edition of Your Money Matters, but do stay tuned for more news and updates on the other side.
हाथ बढ़ाना साथी रे जिंदल साथी सील साथी रे अरे सॉलिड इसकी फील है जिंदल साथी सील है दोस्त की स्टेनलेस स्टील है क्वालिटी में दम है साथी रे
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
जिंदल स्टेनलेस, India's leading producer of stainless steel.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices.
All right, a large acquisition that has been announced by Sun Pharma. We have the management here with us to take us through some of the details which have not yet been addressed, hopefully. So, Kirti, Jayashree, so good to have you on NDTV Profit. My first question to you, Kirti, it is a difficult time. When the Ranbaxy turnaround happened, things were very different. The world was very different. Right now, we are more than 2 months into a war situation, which is having an impact across the world. Cash is king. At this particular time, buying out such a large company with a huge amount of debt, and the turnaround is what you're pitching for. How difficult, or the confidence that you bring, that what is going to be the rationale for the turnaround of Organon after the acquisition?
Sure. I think what I strongly believe, times are always challenging. There are sometimes good times, there are challenging times. But my philosophy is what we can do during the challenging time is equally important.
Yes.
So when we are looking at Organon as an acquisition, it's a large asset. It's the same size asset like Sun Pharma. And by acquiring these assets, if I am able to grow the business, I am able to generate the synergies, then it's a good acquisition in my opinion. And time, there will not be a perfect time. Like you said, Ranbaxy, when we acquired, the time was good. But now the time is challenging. And we don't know how much this time will last, being challenging. But during this period, if we are able to bring back growth in the business, then I think I will be very happy that we have done the right acquisition for Sun.
So what is the timeline that you have set internally for the turnaround from 1 or 2% growth of Organon to higher single digit? In how much time and visibility, if you can give at least by internal matrices?
Sure. So what we said, I think you have to look this business in two lenses, is we will generate certain cost synergies.
Yes.
And this cost synergies, close to about $350 million, will get generated over a period of 2 to 4 years. And in my opinion, there are good or large number of sales synergies, which right now we are evaluating, and it will help business to grow further.
Yes.
And it will help to grow all three business segments.
Yes.
As in, like Organon has an innovative business, then they have Biosimilar, and they also have established product business. So in all three business areas, I'm looking at how do we grow. I cannot give exact time when we can bring this growth back to the track, but the effort is to do at the earliest possible date.
So like the cost synergies that have been mentioned, Jayashree, is $350 million in 2 to 4 years. There are revenue synergies that are estimated, and then the growth outlook, which you have not put a timeline on. All right. So, Jayashree, when we talk about the cost synergies, you've given the timeline. You said the debt EBITDA levels, and that is 2.3x, which you are comfortable with. Dilip Sanghvi also stated that there is high debt and high risk, and I'm a risk taker. But I want to ask you one question. When it comes to corporate finance, debt equity is a very important factor in getting the required cash flows and generate the growth capital also by debt or equity. It is around 6 times back of the envelope calculation. How are you going to really, give a rationale to such a high level of debt of 6 times of your equity, and also deal with the finance charge at the moment with the huge amount of debt? Because even though EBITDA accretive, EPS accretive, you're saying, but from EBITDA to PAT, a lot will be eroded in terms of finance charges.
Okay, here's a good question. Let me answer it in 2 ways. Sure. One, both these companies, Sun and Organon, are cash generating entities. Together, at a pro forma level, they generate about $2.5 billion in terms of cash. And with the growth opportunities that we just spoke about, and the cost synergies, the cash generation would only increase over a period in time. With all of this and a very disciplined approach, which Sun is used to, we believe it would be sufficient to look at debt repayment at a decent period in time. Sun has a strong balance sheet, and based on our discussions with the credit rating agencies, we would have a good credit rating. And
what is a decent timeline for debt reduction?
We are not coming up with a timeline at this point in time, but we think it would be lower than what currently Organon has been looking at in their financial projections.
All right, so $2.5 billion combined of free cash flow, but also growth capital is required. All of it cannot be going in for the debt, servicing as well, Jayashree.
I'm sure.
So, looking at the cash component that you have ascertained to give $2.5 billion out of the total enterprise value that you have already stated. So, in that, what is the last cash equivalent with the Sun Pharma? In that also, do you require mezzanine or a financing, so to say? How much cash do you have, and $2.5 billion of full cash do you have?
Yeah, currently we have about $3.1 billion of cash, and 2 to 2.5 would be used out of our current cash surplus for financing the transaction. The balance of about 9.25 to 9.75 is what we are looking at as an external borrowing.
Right.
Here too, our idea is to see if we can swap the existing debt, discussing with the bondholders of Organon, and if that is possible, only the incremental would be a additional financing that we have to pick it up. And we do believe our credit rating would be better than that of Organon today, and therefore the cost of financing should also be in comparable terms. The reason why I'm saying comparable is some of the debt that has been contracted by Organon was way back when the spin-off had happened from Merck, and those days the interest rates were lower. So we should be able to get a good interest rate, in our opinion. And with the cash surpluses that we have currently and the generation that will come in, that would be good for us to look at the debt repayment.
Right.
You had a question in terms of would you need capital for further acquisition of assets? Obviously, it would be required. But for growth, as Kirti mentioned, there are 2 areas that we look into.
Sure.
Growth by investing in marketing. Growth by leveraging the platforms of Sun and Organon. Growth by in-licensing. So each of these would require some amount of capital, and it has always been factored in both the companies' long-term plan.
Right.
So I don't think that should be a constraint as we go forward.
All right. So that bond, do you have visibility on when the bond maturity could really come in after your acquisition is complete? The first ones, are they maturing a little, in the recent times?
No, we do have visibility in terms of the bond maturity, but I think it will be too premature for me to discuss about the...
Sure. So, Kirti, talking about what you have really gained over here, apart from the global diversification also, which is important right now, and two areas where you sell already existing products and you increase the platform and distribution network that you're selling in. And the second is the growth, also committing to the growth prospect of future, which is biosimilar. But biosimilar entry, while it is a very positive direction for Sun Pharma, but on the other hand, it's a very competitive space. Every pharma company is looking at it for a growth. With this, what will be your USP and moat in really being ahead of the competition with a leverage buyout?
No, I think what's important for you to understand is the biosimilar market dynamics. So today, Organon is the 7th largest player in biosimilars worldwide. And they have 6 to 7 products already on the market. So they have a commercial infrastructure, which is available through which we can sell the biosimilar products. Today, Sun do not have any biosimilar product except few products in India. And what is important for you to also understand is large number of biological products, they are going off patent. As an example, I can tell you is like product close to about $350 billion are going off patent by 2035. So that will also give us a lot of opportunities for you to develop new biosimilars and use this platform to launch them across the world.
Right. So that's 10 years away from now, Kirti. The initial stage of growth and deleveraging will have to be heavy lifted by the combination of the two companies in the existing portfolio that you have, right? So that will be the task ahead for you. But when we really look at, the in-licensing, out-licensing, the line extension you spoke about, biosimilar, and of course, women health, which is the primary thing. And with this acquisition, it puts you number 3 in the world. What are the growth opportunities over there? And out of the 3 segments of 51% with established brands and generics, as well as innovation, and third being the new products, biosimilars, in this, what will be the biggest growth driver in the foreseeable future?
No, I think you need to put this into 3 buckets. So one part is innovation. So innovation, our current portfolio is 20%, it is growing to 27%. So as I see, this is a part where we need to do in-licensing of the products in women's health area in terms of dermatology so that it can continue to grow. So that growth will be much higher. Today, all our innovative business is growing in double digit. Coming to established product business, which is close to 50-51%, is not growing. So there we have a lot of good ideas in terms of how do we extend the life of the current established brand and how do we launch new forms of those products, new formulations, new combinations, so that they also start growing. But they will not grow as fast as say like an innovative product. And of course the biosimilar is already growing, like it's growing by 13%. And what I talked is by 2035 is the product patent expiries. But there are good number of product patent which will keep expiring every year. So I see the growth opportunity in all 3 buckets. The numbers will differ, but they will keep growing.
In your view, which is going to be the highest growth driver?
Now, of course, means in terms of revenues, the innovative business is always a higher growth driver.
All right. And Jayashree, when we really look at the overall numbers, and you said about the synergistic impact also of 2 to 4 years. In the first year, what part of that synergistic benefit can really be accounted for? Give us a little sense and the rationale behind it.
I think the synergies will start kicking in from year 2 to 4. It would be too ambitious to think that the synergies will come in year 1. In fact, year 1, we could see some amount of cost that could play in because of integration, because of transaction costs. But over a period in time, say about a couple of years, the margins would improve with the synergies kicking in and the growth opportunities also coming in our way.
So will it be also correct to say that for 2 years, there won't be synergistic benefits which will come in while the debt clock will already start, and yes, you are EPS accretive, but from EBITDA to profits, your financing cost will also weigh in.
Yes, the financing cost will weigh in all through the period until we repay the debt. Having said that, these synergies as they come in will help in improvement of the margins.
And sales synergies, will they start kicking in from the first year? Is that an estimate also?
At this point in time, we only have those ideas. We would be working over the next 6 to 9 months before the closing in terms of further solidifying these ideas in terms of actionables and also looking at the time frame and the values.
Sure. And Kirti, my final question, of course, global diversification is one master stroke with this acquisition. I must say that because our dependence on US has cost us a lot in terms of the tariff uncertainty, which we really looked at for a longest time. And of course, with the new tariff structure, which has been last announced by the US, in that, what is the impact on Sun Pharma at the moment, and how are you going to tackle it, and what is going to be the actual impact on the numbers?
So as I said, it's like tariff impact on Sun will not be very big. We are not quantified and told that the exact number. But we believe that we will be able to manage the business without having much impacts on our bottom line. Yeah.
So Illumia, that from your specialty product portfolio, from Korea, so that's going to really be attracting the tariff that has been newly announced by the US. And that is a fairly large, sizable business for you from one product. So therefore, I wanted to understand.
No, this is a very complex subject, and we are also working on this to see that it doesn't get much impacted into the business. I won't be able to disclose all the details, but at a certain point of time, we'll also talk about tariffs and tariffs impact on Sun's business.
All right, Kirti Jayashree, thank you so much for joining and taking my questions very candidly. Thank you.
Thank you. Thanks for it.
Abhizar Divanji, founder of Neostrat Advisors, joins us now on the show. Obviously, I'm not going to ask you about the stock price and the way Paytm is reacting, because we know technically the two entities have nothing to do with each other. But the way the Reserve Bank of India has come down on an issue which, at least in the mind of the market, had been wrapped up, does it also display the low tolerance threshold that the regulator has for whatever took place in Paytm Payments Bank?
No, very clearly, the regulators' angst against Paytm as a group with regards to the functioning of the payment bank was very evident, 2022, 2024, and now, frankly, it is about to shut it down. Very frankly, this was the logical conclusion to what had been said earlier. The earlier language also not less harsh. So I think a harsh closure to this was expected. But I don't think this is any new issue that the regulator has with Paytm. It's all the legacy issues that are now coming to fore. And one of the things that the regulator does not necessarily like about most regulated entities is the slackness with which you look at remedial measures. And I think that has happened in this particular case, which is where the regulator has lost confidence in the entity.
Abhizar, having said that, Vijay Shekhar Sharma, of course, stepped down in 2024 to keep an arm's length from all of this at Paytm Payments Bank. But somehow, everything that happens around this bank continues to haunt whatever he is doing now, and which is why you're seeing that kind of a negative reaction. Explain to us why that linkage, at least in the minds of investors, has not been completely broken.
No, but it is not completely broken. Let's look at it. I mean, the whole ecosystem that Paytm has created, which is a great one, by the way. In my opinion, among the fintechs that exist today and all the competition that you've seen around payment infrastructure companies, Paytm is the best. There's no doubt. Now, coming to the issue at hand. The issue at hand is that when you say, oh, I've stepped down from the regulated entity and I don't control it anymore as an arm's length, obviously everybody knows it is not the case. There were too many comminglings involved. And frankly, the business model required the commingling, and I don't see a problem with the business model. So the commingling was that yes, there was a deposit account sitting in a payments bank, and there were all intermingled services being offered around payments, be it merchant-related acquisitions, be it merchant-related trading. All of that was happening on the basis of the larger infrastructure created on Paytm. So any which way, just by one individual resigning, are you saying that you're going to divorce yourself from an existing platform which is so commingled? So this is what I mean when you say that if you try and do remedial measures which are not, seriously thought through, the regulator sees through it. I mean, clearly the payment bank linkages were there, and the issue, at some stage they were talking about why are you using the same platform for the payments platform as well as the bank. The real issue was that of the slackness with which customers were onboarded. And the real issue that maybe the owners had to realize at that time is that the bank is a custodian for clean money entering the system. And that is why KYC and ALM become very, very important. You're onboarding a customer. You're allowing somebody to open a bank account. You're allowing him to legitimize transactions which otherwise are outside. Now, if you allow him to enter the system, he can play with the system after that, right? And that is really why RBI is so concerned about the banking system, because the flows within the banking system become uncontrollable once a customer is accepted. And hence, KYC becomes a very significant component.
Okay. These are, important points that you make right now. But my question over here is, if you have to look at the next steps now for a Paytm, is it that it's all decks clear for the other aspects in terms of business, number one? And two, if you have to look at the future of payments bank, because if I'm not mistaken, there were 11 original licenses that were issued, right, on an overall basis. Only 6 remain operational. Is there a structural issue that you could also look at when you have to look at the payments bank model fundamentally?
Okay, so I'll answer the question in 2 parts. First part is, does it clear the text for Paytm to do other stuff? Absolutely. I think anything which involves a fiduciary acceptance of deposits or a banking activity is a complete no-no. But if they do not control a bank, then there are more features that they can offer by tying up with banks. And they're doing it. I mean, they already have tie-ups on the UPI with so many other banks. And that will continue. So the whole process, ecosystem, which will enable them to either get a PPI license or a wallet license will continue to happen as long as they're not in charge of opening savings accounts. So that is, I think, as far as Paytm is concerned, I think the model is excellent. I think it's an opportunity for other banks to tie up with them to see how they can grow. So for sure. Now the second part of your question, which is the future of payment banks. So, payment banks were envisaged to be banks which will get the unbanked to the banking system. That was Dr. Raghuram Rajan's vision to create a category of banks which did that. I think it was half a bank, and because it was half a bank, it was always a problem. So it gave the security to people who are not necessarily used to banking to say that your money will only be deployed in government securities, don't worry. So you're not going to lose too much. Come to the banking system. But that was, I think, expecting too much of the unbanked to try and understand that, how is a GSEC more secure than a loan? I think that's where the model failed and the deposits never came in. So what happened is, people who are doing payments bank and the successful ones today are one who are commingling it with the larger payment ecosystem. And there is nothing wrong in commingling a payment bank activity with a larger payments ecosystem. Now look at the Jio model, or look at what Airtel is about to do. And they have a payments bank. That payments bank is going to be a deposit taking entity, which basically gives them access to customer data in terms of how the customer's liabilities behave. How the customer deposits money, where is money coming from, where is he spending the money. So if you capture a savings account, that part of the customer's data is available to you. Now on the other side, Jio set up an NBFC, Airtel is now going to set up an NBFC. That NBFC may, on a consent basis, be able to use that data to figure out how the lending can be done well. Now both of them have pipes which are very different. They have the telecom pipes, for example, which pipes means just a sales engine. Through the sales engine, they will onboard a savings account and make the customer eligible for a loan in their other entity. So that's how that ecosystem will work. But the funds are not commingled. That's important to understand. The deposit is not used to give you the loan. The deposit is used to invest in GSECs. But a separate set of capital pool has been created to do the lending business. I think that model of a payments bank will work. And the important thing is that corporates are allowed to do this. So the corporates can have an NBFC come payments bank model, which is what Jio is doing and Airtel will do. Those models will succeed.
Okay, it's going to be a tricky trade. And I think one point that you made, and which stands out for me as well, is that just by one person resigning, you can't divorce from the whole situation. You can't just say, oh, I don't really know you, and walk away. There is a clear stake there. And I think this is going to follow Vijay Shekhar Sharma around just for a bit, even as he hopes to rebuild. Thank you so much, Abizar, for joining in. Always a pleasure having you. Prateek Agarwal, MD and CEO of MOMC, joining us now on the show. Prateek, great to have you here with us. You know, we've been talking about how perhaps Indian equity investors, along with those in Asia right now, are beginning to look beyond what's happening in the Strait of Hormuz. It's important. Crude is still at 107, but fair to say we're not obsessing about it as a major negative as we were, say, even 3 weeks ago?
Well, if you look at the level of the market, you can derive that outcome, but I think something else is happening. One is the markets are lower, significantly lower than where they were in Feb. Okay, it is known that this thing is causing a very large amount of stress to Asian economies and India in particular, which means when this thing sorts itself out, the uptick can be sudden and sharp, and maybe people are positioning themselves for the uptick. The challenge here is that if this uncertain period elongates, then you will see the patience wearing off. So I think it is the opposite. Till there is hope that this thing resolves quickly enough, markets in India will hold. But if one starts to believe that this thing will elongate, then the patience will wear off, because today mostly people are positioning for the rebound trade. That said, if one takes this as a big interjection in the journey of the markets, this has brought into focus things like the power sector, renewables in particular, spaces like EVs, spaces like defense, like never before. So the leadership could move to newer spaces after this thing sorts itself out.
In that whole play about alternative energy solutions for India, renewables, etc., that's an idea that on paper sounds very exciting, but we haven't really seen the performance as far as those stocks or those group of stocks are concerned. Do you think that's set to change? Is that an idea worth looking at from, say, a medium to long-term focus?
I would think so, because, coal. So the whole idea is to move away from oil. We are getting a big oil shock. So when it happens, policymakers will do everything to prepare the country, so that this thing doesn't repeat itself, which means going back to indigenous supplies of energy. That could be coal, that could be solar, that could be wind, and a combination. Now the thought is that, as you build a new economy, you don't want to go back to coal in the way it served us over the last 50-60 years, because it dirties the environment. So the time for renewables has really come. The prices, X of best cost inclusion is cheaper than fossil fuels. So I think renewables are the way forward.
I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with
Good evening. Welcome to The Big Question here on NDTV Profit. I'm Vikram Oza. Tonight, we're talking about a new kind of cyber threat, one that does not wear a hoodie. It does not need sleep even. In fact, it doesn't wait for any kind of instructions. What we're talking about is right up there. It's called Mythos. So what is Mythos? It's a powerful new artificial intelligence system. It has been developed by Anthropic as part of its broader Cloud platform. This is, of course, the company's most advanced model so far. It's designed to do a very critical job, which is to find hidden vulnerabilities in existing software. And it does that at alarming speed. It does it at a scale that humans simply cannot match. So let me tell you, this is what Mythos can do. It can identify deeply buried security flaws. And that includes your zero-day and your decades-old weaknesses. And it's across operating systems, it's across browsers, cloud platforms, and complex enterprise software. So these are gaps that we are talking about that human experts may have missed over time, often for years. It's the same capability that can help secure systems, which can also be used to break into them. So yes, we are talking about a vulnerability, about fixing it and protecting it from the same ecosystem. It is precisely why Mythos has become controversial, because Anthropic has refused to release it publicly because the risks are so high. They are warning that in the wrong hands, Mythos could pose serious cybersecurity and national security risks. So access has been restricted to a small group of major corporations and institutions. So companies like Microsoft, Amazon, Apple, Nvidia, Cisco, even JP Morgan, they get access. That way, the vulnerabilities can be fixed before they are actually exploited by hackers, by bad actors. And yet governments, they are very worried because the stakes are enormous. Financial networks or power grids, hospitals, telecom systems and government infrastructure, all of these are at risk. They could all be exposed, and that too, it could happen faster than regulators or any kind of cyber defenders can actually respond to the crisis. So current cyber laws and oversight frameworks, they were never designed for autonomous AI systems that are capable of this, of uncovering and then potentially exploiting weaknesses at the kind of scale that we are talking about that Mythos is capable of. And here in India, the concern has reached the highest levels as well. So the finance minister has taken a look at it and flagged Mythos as a new and poorly understood threat, as it were. She is warning that existing protections may not be sufficient and has been directing banks to work together on a coordinated response to the Mythos threat. So AI itself, she has said, may have to be used to counter AI-led risks. Hence the issue. The issue is this: when machines can find weaknesses faster than humans can actually fix them, then cybersecurity, economic stability, and national defense, all of these become one single risk, which is why our big question tonight. So as the Mythos threat is now deepening, as it were, and we're talking about it going beyond the banking sector, across all sectors, not restricted to one government, but across the world, then what do we do? Are we ready for AI-led cyber attacks? That's the core question right now. Can we even keep up with all that AI is capable of and what it can do? The harms that it can cause, but what about the kind of opportunities that exist over there as well? All of that in this debate we call the big question, and we've got a great panel to tackle this. Let me introduce you to them. Joining us on the show tonight, we have S. Chandrasekhar with us. He's Managing Director and Chief Executive Officer at KNS DigiProtect Services Private Limited. Good to have you. That's a company into cybersecurity and digital risk protection. We're also joined by Pawan Duggal. Pawan Duggal is a leading cybersecurity and technology law expert, and he tracks the legal and governance challenges that emerge from the AI-driven threats. Also with us is Abhinandan Jain, Chief Customer Experience, Growth and Delivery Officer at Iono. He brings in the enterprise and customer-facing perspective on how organizations could potentially be responding to this fast-evolving AI-led risks. And joining us as well is Sharat Chandra. He's founder of Empower Edge Ventures, and they're into advising companies and policymakers on strategy and risk, and we'll get that impact on the banking sector, especially from him. So let's begin the conversation, gentlemen. Thanks for making the time for the big question, and I'd request you to raise your hand every time you have something to add or perhaps disagree on with your co-panelists. I'll come to you as soon as I can. But let me start by asking Mr. Chandrasekhar, this is about cybersecurity in the age of AI. So if an AI system like Mythos can find these critical flaws faster than humans can or ever could, has cybersecurity already lost that traditional advantage it had?
Yeah, you can argue that it has lost the traditional advantage if the cybersecurity experts think in a traditional way. So we'll have to rely on human ingenuity to beat the machine. For example, there are certain kind of human behavior when a human interacts with a machine. For example, the mistakes, the corrections. Suppose you're typing a document, you would probably go back and forth. If a machine is doing it, you would get it in straight lines. So that is some kind of a behavioral thing which a system can easily flag if there is an AI trying to do some kind of scanning of the network. Secondly, many other kinds of vulnerabilities in addition to the behavior, the time taken for a login. An AI will log in maybe hundreds of times in a second. A human cannot do that. So there are many possible measures which human ingenuity can rely on in order to try and defeat this threat. But yes, I fully agree there is a threat.
There is a threat, and human ingenuity is going to be tested to its fullest. Mr. Duggal, where do you place human ingenuity in able to, take this on? The specter of cyber warfare, are we now in that phase where these cyber attacks can happen faster than detection or even investigation? Even that decision making, which is crucial, very important, it has to be very fast by humans. Are we in that stage where we are able to tackle this?
Humans are already lagging behind. So if you think that we are still in control, then you are obviously dreaming in the daytime. The Mythos release tells us that this technology is moving at a far bigger space than what we are currently imagining. Consequently, we as a race have failed to put in adequate legal guardrails for the purposes of ensuring that this artificial intelligence does not get misused against human interest. You may talk about human in the loop, but if you have no legal guardrails well in place, even the human in the loop as a paradigm is likely to fail. And now with the world exceedingly moving towards not just agentic AI, but also artificial general intelligence, and finally converging onto super intelligence in the next few years, I think the time has started ticking. We have to wake up out of our deep slumber. Unfortunately, we think AI is only 2x, but actually AI is already working at 20x the speed.
Yes.
With the result, our ability to conceptualize this paradigm, our ability to try to control this paradigm is getting diminished with each passing day. Therefore, the quicker we start coming up with legal frameworks and legal guardrails, the better it is. But let me also underline one basic fact. If you're expecting AI law to totally go and control AI, that's not going to be happening. Why? Because we'll have to deal with this entire problem from a holistic angle, from a technical angle, from a governance angle, from a legal angle, from an accountability angle, and also from a social angle per se. So every of these initiatives and approaches will have to converge together. Otherwise, this new release tells us that now a 12-year-old boy will be more than sufficient to go and put the entire electricity grid of a major nation down in just a few minutes. All it requires is just small bit of ingenuity on how you can misuse this. And mind you, we already have news that hackers are waiting with the eager breath to go ahead and hack into this exercise. So I think we are in for some very stormy days ahead. The quicker we put our acts together and the quicker we start getting prepared for this scenario, the better it is. Otherwise, let's prepare it. That like every day, sun rises, cyber security breaches will be the new normal, this time by AI, with the human ability to detect, investigate, or prosecute the same being virtually negligible.
So very interesting that you're saying what you are. The scary part of it is that a 12-year-old can do it. So when Mr. Chandrasekhar starts out by saying that it depends on human ingenuity to be able to take this on, you're saying that it might take human ingenuity to cause as much harm. Mr. Abhinandan Jain, when both attackers and defenders are going to be using AI, in your understanding of where we stand today, who really has the edge today? And why do you think that one has the edge over the other between the attackers and the defenders?
No, great question, Vikram. So let me start by framing. See, cybersecurity hasn't lost, but the rules of the game have changed, right? So AI